a variant.
This meeting is being recorded.
Okay.
All right.
got
Sorry about
Um,
that.
No worries. So the consensus was to postpone the staff school until winter time, and obviously we're doing it. But again, who would know that at this time we would have another variant, Omicron. So, that's why we went virtual for this staff school. I mean, not only it's safer for everybody, but also allows more people to attend. Typically, we can only limit the staff day to 57 people to the facility in Dudley Town Hall. But now we have well over 100 people attending virtually, so it's much easier for everybody. And you can, I won't say you're all multitasking, checking emails at the same time, but because these are important things to talk about or listen to. But regardless, virtual is obviously a much easier way to go. And also it's free. You don't have to worry about paying for this at all. So we obviously enjoy the opportunity to present to you all. Let's see. Also, if treasurers and collectors want to attend, they can certainly do so. And again, it's a great way to get a refresher, but no class credit, sorry. I would also like to thank all our presenters today for donating their valuable time. This is a volunteer organization. Nobody's getting paid for this. So again, appreciate the contributors that are going to be speaking today and volunteering their time. So for today's introductory collector staff day, we have James Crowley from the DOR and DLS, Division of Local Services. We will then have a short break and then have Ron Mendez from the City of Newton, and he will talk about motor vehicle excise. And then there will be a 45-minute break for lunch. And again, sorry, virtual, we can't give you food, so that's on you. No lunch. Then at 12:45, we have Dr. Ellen McKay from the megalopolis of Shutesbury, the huge town out west. And she will talk about property taxes, tax collection process, and municipal lien certificates. Then we'll have a few minutes for questions. And again, please mute yourselves if you're not already. If the presenters have an opportunity to let you ask questions, they will ask or allow you to do so. And finally, and last but not least, I would like to thank Georgia Kalivas, who's our chair of the Education Committee. She's our third vice president, and the rest of the Education Committee for all their hard work in bringing this program together. And also not to forget Beth Whitman, who is our executive director, there in her fuchsia purple jacket. She's coordinating everything today. So I will shut up and let you guys get started. Jim, take it away.
Okay, thank you very much, Chris. Thank you for the introduction. And today, what we're going to do is we're going to go through a number of PowerPoint slides. Can we start out with the first one, Beth? Let's see if we can.
Yeah. Everyone see
Yes.
that? Great.
Yes, the page one, that's a good place to start. So we have, I'm Jim Crowley. I work for the Bureau of Municipal Finance Law. It used to be the Property Tax Bureau way back when. And we get involved with cities and towns. I'm an attorney. I went to BU Law School, Boston College undergrad, and I've been with the department for a few years, and I've seen a few things. And I think in making these presentations, I encourage you to make a comment. If you want to boo the guy from the state, go right ahead. I mean, we'll make it a pleasant excursion, and we'll cover the material, and we'll maybe have extra time left over. But in any event, we'll try to make it a pleasant working day. So as an introduction, I'd have to say that one of the things that people stress is there has to be a good working relationship at City Hall or Town Hall. That makes the thing work properly. So for example, if you work in the collector's office, you work with the assessors because they give you the names on the tax bills. You rely on them for certain information. And then if you have a receivables, you're supposed to have a collector's control book. And you should at least monthly, I would hope, you'd have to reconcile the control book with the accountant's ledger to make everything is in balance. And you work also with the town clerk or the city clerk, because certain documents, as we'll discuss, are on file there. So it's all part and parcel of life at the town hall. As far as tax bills are concerned, we get questions from time to time about errors that appear on a tax bill. You name it, there's a mistake been made on the tax bills. So what do we advise? Well, every year the department produces guideline releases on tax bills, whether you're a semi-annual community or a quarterly community or something in between. So we have a format, we have models that go into it. And all we say is if you follow the models for the tax bills, you'll avoid problems. So, I mean, that's the whole thing, because you don't want to redo the bills. You don't want to send messages out in the newspaper and on the website saying we made a mistake about this, we got to redo that. We want to make sure everything is in a proper way. So I think we'll go down a slide. If you advance, next slide. Yeah, one of the big things that came about back in 2016 was the Municipal Modernization Act. And here it was perceived to be a good thing to streamline some of the statutes and bring that up to the 21st century. And that's what they did. They got rid of what was perceived to be obsolete laws. And most of the provisions went into effect in 2016, and some went in a little bit later in time. But again, there are efforts from time to time on legislation, further amendments. And also communities get special acts. So we'll discuss some of the special acts that have come about that govern just that particular community. So, I mean, you have to be aware of that. And to find out what's in effect in your town, you've got to work with your town clerk or city clerk to see what was actually adopted. Because sometimes questions come up from the towns themselves. Did we ever adopt this? Well, the person who's responsible for all the records is your town or city clerk. So again, you got to keep that on hand. Or another thing is, if you work with a district, what are the provisions about the special act regarding the district and how can you find it? Some of the districts go back so long that the name of the district is changed 2 or 3 times. And you have a heck of a job trying to find it in the acts and resolves. So again, you have to rely on your town clerk for that particular thing to do. Now, on our next slide, we go down, we have the duties of the collector. Well, go back one previous slide, Beth. Thank you, Beth. Okay, the idea of the thing is that if you're a collector, you're supposed to collect taxes and interest on delinquent taxes. But if you ever look at chapter 60, section 2, it also speaks of collector's interest, not the interest on the tax, but collector's interest. So what does that mean? That means that obviously the tax collector can have his or her own bank account. And that's because of the language that's contained in chapter 60, section 2. There's supposed to be a weekly turnover to the treasurer under the terms of the statute. If you have tax day in your community and you're collecting a lot of receipts, presumably you turn over the money a lot sooner than once a week. So it all depends upon the circumstances. And then you can have agreements with banks to receive tax payments. These are your lockbox agreements. And again, they're all set by statute. Now you send out the tax bills, and that's under chapter 60, section 3. And as far as the bills go themselves, obviously you send the bills, and the tax list and warrant come from the assessors, but who pays for the printing of the tax bills? Well, that's one of those things that it depends upon what the rule is in your particular community. It can be either the assessors have the money in their budget or the collector has the money in the collector's budget. But in any event, it's up to whichever department has the appropriation that is responsible for the printing of the bills. As far as the bills themselves, you can have in the bill what is called an insert or a stuffer. And what does that mean? Can you just put anything you want in there? No. It has to be non-political municipal information. And the information is included as long as it does not up the cost of the postage with the permission of the Board of Selectmen or with the permission of the mayor. So what would be an example of that? Your community has just adopted a debt exclusion, and the question now is, what's the impact on the single family tax bill? You could put information in the envelope about that particular thing. So these are what we call inserts or stuffers. As far as sending the bills themselves, we get questions all the time about care of bills. Now, there is a provision in the statute about care of bills, but at the end of the day, the taxes have to be assessed to the record owner as of the January 1 date. And secondly, if you're going to make a tax taking to perfect the lien on the property, you, by statute, chapter 60, section 16, you have to send the demand notice to the assessed owner. You cannot, and that's another point. You can go in on the phone, you can call the deadbeat taxpayer every day of the week. You can send out a demand notice to him every day of the week, but you can only charge one demand fee. You can't just have multiple demand fees. You can only charge once. Now, on the care of bills, it's sort of like a better way of looking at it is from the perspective of death and taxes. We always get involved with death and taxes of the revenue department. And this is a case where assessors and collectors work together. We're in fiscal year 22 right now. The assessment date is January 1 of 2021. So it's 6 months before the start of the year. Now, Richard owns 88 Main Street. He's the record owner. Now, unfortunately for Richard, he dies on July 17th of 2021. The fiscal year 22 taxes are still going to be assessed to Richard since he was alive on January 1 of 21. Now, then another example comes in about a proper assessment. Let's assume Richard dies on September the 30th, 2020, before the start of the fiscal year. Now, this is the critical part. A probate court filing has been made for Richard's estate, and that was made in December of 2020. So now the assessors are responsible for what's on record at the registry of deeds for that county or district of the county, as well as in the registry of probate. They're responsible. So in the probate court, we have the probating of the estate, the application, and that's accompanied by a death certificate. So we know from county records that his death is on record before January 1 of 2021. So that again is the assessment date. So what happens next step in the proceedings is that the probate court issues a decree in April of 2021, which approved Richard's will, where Richard's son Alfred is named as the owner. That is to say, he is the devizee of 88 Main Street. And Alfred's title to the property reverts back to the date of Richard's death, which was in September of 2020. So the assessors are charged with knowledge of records of the registry of deeds and the registry of probate. And then because we know that this person, Alfred, has title, that they must assess the 22 taxes to Alfred. Now let's take another example. Richard dies in September of 2020. A filing was made in probate court in December of 2020. Fiscal year 22 starts out. Tax bills are being prepared for 22, and the probate court has not issued a decree. So what do we do now? Fiscal year 22 taxes should be assessed to the heirs of Richard, since the probate court has not yet allowed the will. A tax taking, the reason we're going through this is that a tax taking was challenged successfully.
I can't hear Jim.
I muted him by accident.
Okay, unmute. Am I all set?
Okay.
Okay, so
Great.
we're going through. The important point of this is that everything is determined by the assessment date. If the person was alive on the assessment date, you assess it to him even if he dies subsequent to the event. If he dies in the calendar year before the start of the fiscal year, and that's on record at the Registry of Deeds, then you would have assessment to the heirs of. If we know who actually inherits the property or gets it from the probate court, again, you assess to that particular name. But a problem came out years ago where tax taking was challenged successfully. What happened is, for some crazy reason, the assessors kept assessing the properties of the heirs of a taxpayer who was long deceased. And the bills went out, they were returned to the town hall. The collector made a tax taking, and the property went into treasurer, went in for foreclosure in land court, and the land court said we have an invalid tax title because the assessors had a decree of bankruptcy of probate court as to who actually owned the property. And as a result of that, assessing it in a general manner to heirs of was not right. So the entire tax title process was thrown out and they had to start all over again. So again, ownership, another thing is that when people die, the ownership of the property goes back to the date of death. So again, that's rather important. And you have to assess it to the right party or you have an invalid tax title. And it all depends. I know in some communities, I've worked in communities that you'll see a short expression, a state of, giving the name of the taxpayer. Well, again, that seemingly is fine, but it's technically not correct because an estate of assessment is supposed to be made when you have a will contest. That is to say, there's a question as to the validity of the will. So again, that's a very rare instance that you'll see that, you know, arguments about undue influence or a later will can't be discovered. I mean, these things come about, but at the end of the day, you're supposed to assess everything as of the January 1 date. As far as the demand fees, we're going back to the slide number 3. I have an advance dealing with demand fees. The demand fee years ago was 50 cents. Then it went up to $1. Then it went up to $5, and now it's up to $30. The question is, who makes the determination as to the demand amount? Is it going to be the collector, or who is supposed to make the decision? If you look at the statute, chapter 60, section 15, it doesn't tell you that. It's completely silent. It just says up to $30. So who makes the decision? Well, in a bulletin the department sent out a while back, it was stated that in the view of the department, the decision should be made by the legislative body, whether it's town meeting or city council or whatever, because that's something that's really not left to the collector's office. I know some collectors, I believe, have done that, but again, better action would be made by the legislative body. Another question came up as to the amount thereof. Can you have a sliding scale? In other words, depending on the amount of your tax bill would be the amount of the demand notice. So that if you have a $5 excise bill, you'd have to pay a smaller amount for your demand fee. But if you had an expensive real estate bill, you'd pay a higher amount. And the answer is you can't do that because there has to be a fixed amount for the demand. There's one demand fee price, and there is no quote unquote step up fee on dealing with the demands. Another thing about the sending out of tax bills is concerned, when you send out a tax bill, you should be filling out what is called an affidavit of mailing. And the affidavit of mailing certifies that the tax bills were delivered to the post office on such and such a date. And this avoids any controversy with the taxpayers as to the time of the mailing or the sending of the tax bills. And the affidavit of mailing has got to be filed where? In the collector's office, and it's also filed in the town clerk or the city clerk's office. Now, if you look at the language of the statute under chapter 60, section 3, it says that the affidavit of mailing is what they call prima facie evidence that the bills were sent on that day. So if you're going to be measuring interest calculations, which could impact an appeal to the appellate tax board, for example, it's critical that you know when the bills have been sent out. We also get issues that come up about proper assessment. We always will deal with it at this time, dealing with bills. Let's say Johnny Smith owns a 2-family house. And in March of 21, he files a master deed at the Registry of Deeds, and he converts the 2-family house into a condominium, 2 condos. And he keeps one of the units and he sells one of the units. The buyer of unit 2 is there. He bought the property, let's assume, in March of 21. And he goes to see you, the collector's office, and he says, listen, I want my own tax bill. And what does the collector do at that point? Well, the collector has to say, visit the assessors. So if that individual who bought that condo unit visits the assessors, he says, listen, your people are assessing me this property as a 2-family house. It's now 2 condos. Oh, says the assessor, what we can do is we can apportion it based upon a written request from you. We'll divvy up the value of that bill. What's assessed, let's say it's 480,000 2-family. We'll divvy it up based on the value of each of the units. That's great. So now the buyer of that unit 2 gets his very own tax bill. And that's important to him because July 1 is the start of the fiscal year. And July 1 is also the date for personal exemptions. Now, if the buyer of that condo unit was a Purple Heart winner, then he could get a veteran's exemption as of July 1 of 21 for fiscal year 22. So it's a critical about the apportionment of the bill. Now, let's assume for the sake of argument that we have a parcel that's in tax title and someone wants to buy the property. Now, what happened in this particular situation, just to let you be aware of it, is that there was a property in Linfield that was the disputes as to who actually owned the property. And the assessors assessed the tract of land to what is called owners unknown. Now, people say owners unknown. We're in the 21st century. I know this case was in the 1980s, but where did this owner unknown come from? Somebody somewhere must own that property. Well, the answer, of course it is, but we don't have to go back to colonial times. And one of the decisions of the Supreme Court, you can go back 40 years. So the point came up that there was a developer that was interested in buying a portion of the land, the good property, and didn't want the swamp. So what he did is he hired someone, and they went around and checked all the records and the atlases and the utility bills all around that particular community of Linfield to try to track down the ownership of that large tract of land. And the developer was successful. And he sent lawyers down to Florida, and he got heirs of that person to sign off on the acquisition, paying them so much money, and he bought up their rights to the property. Then, having got those rights to that property, what does he do then? Well, under the statute, once a property is in tax title, the assessors cannot apportion it. Only the land court can apportion a property that's in tax title. That's under Chapter 76A of Chapter 60. Chapter 60, Sections 76A. Apportionment, if you look at the language of the statute dealing with the 2-family house, that property was not in tax title. That's under 59, Section 78A. So what we have in that situation, we can't apportion. The assessors cannot apportion in the tax title, but the land court can, and the land court did. As a result of that, a petition was filed. The developer, Royal Barry Wills, paid off that portion of the bill that he wanted to pay off. He left the town to have the swamp, and then he built on that developable parcel a group of very beautiful homes that are called Royal Barry Wills Cape Cod homes, which if you're familiar with the North Shore, they're very desirable. So that was the story of that. So we have a thing called owner unknown assessment, we have tax titles, and we have land court. And so we're dealing with all sorts of things. And we're also dealing with people that come into the town hall to look over town records to try to determine actual ownership of property. So it's kind of like a detective story when you work in town hall. So all that is handled on a day-to-day basis. Now, Beth, if we move it into the next slide, we're going to deal with the duties of the collector while preparing municipal lien certificates. Well, we're going to be covering that in this afternoon a little bit. The only thing that I would say about it is that well, I was a little bit shocked when I found out that the schedule, the fee for recording an MLC had gone up. It's now, I believe, $80. I'll stand corrected, but I think that's the fee to record a municipal lien certificate. If you're in a community which is a very small community and your population is less than 5,000 people, then 5,000 or less, you have 20 days to produce the certificate on behalf of anybody who wants it. And that excludes Saturdays, Sundays, and holidays. And if you're greater than 5,000 population, you have 10 days in order to prepare the certificate. As far as the fee is concerned for it under Chapter 60, Section 23, on a single family home, the fee would be, we think, $50. I know some communities charge more than that. They've charged, let's say, $50. But the idea is that there's a presumption that the $25 fee is valid, and you're supposed to record on the lien certificate the liens as of the date of issue. And then if the lawyer or whoever requests it records that timely, that within 150 days of issue, then the community loses out on any liens that are not listed on the lien certificate. Now, does that mean that, well, what do we do as far as the other duties of the collector are concerned? The collector issues a warrant to collect to the deputy collector, which we covered a little bit later by me and also by Ron dealing with motor vehicle excise. And the fee for the warrant is $10. And then the avenue of work that can be done by the collector, what he can do to as a weapon in his arsenal of collection, he can bring a civil suit against the taxpayer in order to collect the money. So, for example, in the case of the lien certificate, if the collector neglected to include in the lien certificate the fourth quarter unpaid bill, then the lien is lost. But the owner is liable personally for the amount of that bill. And if it happens that due to a refinancing, the lien certificate was obtained, you can definitely go against him in order to get the money. Where the most effective remedy in the arsenal of weapons of a collector dealing with real estate taxes is the tax taking process. And I was a little bit surprised. I believe from looking at the schedule of fees of the Registry of Deeds, I think the recording of a tax taking, I believe, is now $105. It jumped up from $75. I think that's the fee that's charged, or correct me if I'm wrong, but I think that's the amount. And again, that would be paid by the community. And the recording of the tax taking is done for the benefit of the community. It's not done for the benefit of the taxpayer. So again, when it comes time to redeem the property, the town will get its money. We've got questions from time to time about accepting credit card payments. And that was a battle that went on for a few years. And what has been said by the department is that town can accept a credit card payment provided it receives the full amount which is due without offset. And in that particular situation, you could have a convenience fee, but that would be a separate fee charged to the taxpayer that would not be offset or absorbed by the community. The community gets the entire amount of the bill, and then there's a convenience fee that's paid by the taxpayer himself. So again, these are things that are done. As a point also to make is that when you're dealing with fees that are charged by the collector, fees are, as a general principle, are set by statute. And the statute that you can find is Chapter 60, Section 15 of the general laws. And there are other fees that come into mind as well. So if you want to make a note of it and look it up, if you go to our website and do a search for collection fees, charges, and penalties, collection fees, charges, and penalties, you'll have the entire list of fees. So for example, issuing and delivering a warrant from the collector to the deputy collector is $10. The fee for notifying the taxpayer by the deputy that the warrant has been issued, charged is $12, and serving the warrant actual physical presence by the deputy collector is $17. What about bounce checks? Let's say the taxpayer sends you a check and it bounced. Is there a penalty for that? Well, yes, it's under Chapter 60, Section 57A, and that's found in the list of penalties. And that is going to be the minimum of $25 or 1% of the amount of the check if it's more than $25. So again, if it's above $2,500, it's 1%, and it's $25 for any amount less than that. If we look now into our next one about fees, next slide, Beth, going to number 5. If you live in a small community, there are provisions there for the collector to retain fees. For example would be the municipal lien certificate fee. The collector could retain that and certain other fees that I just enumerated. But in many communities, that was wiped out because there was a bylaw or ordinance in the community that would say that the collector is supposed to turn in all of the fees received by the collector's office. And there's a bylaw on that. An example of it is in 40, Section 21, Clause 13, and that you can do so. You have to return in your fees. And then there were also charters of communities that come in and say that the fees cannot be retained by the collector's office. Again, that's done on a case-by-case basis, community by community. The reason why the fee retention is not done as much is because the idea was to increase the amount of the salaries of the collectors and the staff. And as a result of that, the collector could get a better pension because the fees would not go into the pensionable calculations. So again, those are things that were done in communities, and some communities still do that. If we go to the next slide, we're going to deal with partial payments. Can you have partial payment of a tax? What about real estate? What about personal property? Yes, you can accept partial payment of a real estate bill, and you can do so until what time? You can do it if there's an arrears, the property is taxes are delinquent. The taxpayer can pay and make a partial payment. It says in the statute, Chapter 60, Section 22, can do so up to the date an advertisement has been prepared for a tax sale or tax taking. So if you prepared an advertisement to appear in your local newspaper, well, under the terms of the statute, you're not going to accept a partial payment. It doesn't have to actually have to be printed yet, as long as it's prepared. At that moment in time, there is no partial payment of the bill. But if the property is not yet ready for tax taking and nothing has been prepared, then you can accept a part payment of no less than 10% of the total and at least $10. So we're not going to have taxpayer coming in with so many days of small payments. The 10% rule will go in as regard of the amount paid on the real estate. Yep, you have a question? And then as far as the personal.
Thank you so much. Sorry about the chaos. Don't worry about it. Yep, no. Thank you.
Am I okay? Am I muted?
No, everyone else has to mute themselves.
Okay, we all set?
Yep.
Okay, on personal property. Now, there's no lien with personal property. Personal property does not appear on a municipal lien certificate because there's no lien with that tax. Now, can you make a personal property tax payment anytime you want? Well, the answer is no, because under the terms of that statute, that no partial payment is allowed up to the date when a warrant or other process is used or issued for the collection of the tax. So if you have a warrant issued to the deputy collector on the personal property tax, guess what? You don't accept any more partial payments of the personal property. But if it's just, the late payment, in other words, the person is late paying it, then you can accept 10% of the total or a minimum of $10. Again, with motor vehicle excise, there is no provision in the statute for a partial payment of a motor vehicle excise bill, and collectors generally don't accept partial payments because they have a heck of a job collecting it anyway. So again, that's not in the statute. On tax title, the tax title statute was changed, that chapter 60, section 62, and that allows for partial payment. Used to be 25% of the tax. That's gone. It allows for a smaller payment than that. And then the collector then, upon receiving the partial payment, let's assume there is a payment agreement or payment schedule with the taxpayer, the collector says, I will forbear, I will not make a tax taking for up to 2 years if you adhere to your payment schedule. So again, that's allow partial payment of the tax title. Now, what about a tax bill itself? A taxpayer gets a bill and he could have an apportioned betterment, interest. He could have an unpaid water lien committed interest, sewer lien committed interest. And then he has at the bottom of the page, you see a real estate bill. You say, boy, golly, this guy's got a lot on that bill. Well, he comes in with a sum, whatever it is, the payment is. Then the collector is supposed to, and he should be doing it on your software, you're applying it to the betterment, the rate, the water rates, the sewer bills, and so forth. And then ultimately, you come down to the amount of the tax itself. So then, as a result of that, there is going to be an arrearage of the tax. Now, how could this come about? Well, again, if the mortgage company is making the payment, the mortgage company won't be paying these other charges. The mortgage company will just come in with a payment, I understand, of just the tax itself. And it makes the payment. And as a result, the collector, however, when the collector is applying the payment on the collector's records, they're going for the extras and then ultimately the tax. Now, what does all this mean? Well, that means that if a taxpayer is upset about his valuation of his property, or the bank that's in for mortgagee in possession is interested in the valuation of the property, by paying the tax itself, the amount, the initial tax, let's say $2,000, that preserves his right of appeal to the appellate tax board. So as a result, what's on the collector's records and what is on the records as far as the assessors and the appellate tax board are concerned are two different sets of numbers. Same amount, but different allocation figures. So it all depends upon the circumstances. If a person gets a bill and is due coming up in February 1 and is late paying it, he doesn't pay it until February 3rd, he's going to have a tax, he's going to have, let's say, collection costs, he's going to have interest. Well, under the terms of the statute, the collector applies it under the terms of the software. You apply it to the interest, the collection cost, and then the tax. So again, that's important. And because again, if a taxpayer wants to appeal to the appellate tax board, if he incurs interest and his tax is above a certain amount, he can't go there. So again, these are the rules that are involved in going beyond the just the collector's office himself, taking into account the assessor's office as to the abatement process. If we go to the next slide, we deal with the Commissioner of Revenue. The Commissioner of Revenue has by statute in Chapter 58 an oversight rule regarding cities and towns. The statute says that the Commissioner can provide advisory opinions to assessors and collectors. If you're looking at full and fair cash valuation standards, which go way back when to the 70s, the Commissioner of Revenue by statute conducts a certification review of local assessing practices and does so every 5 years instead of every 3 years as it was previously. So that's because of the municipal modernization. So we're involved in, coming in with certification of the valuation. And the assessors are responsible for maintaining the full and fair cash value each and every year. And the department is also involved, the commissioner by statute, with approving a tax rate. So if your tax rate, you're in the approval process, if you're going through it, as the assessors do, bringing in their records electronically or bringing them in, they used to be, and bringing it into the office. Again, the tax rate is set by statute by the commissioner. Now, can the commissioner have the ability to abate a local tax? Now, you can imagine the commissioner would be a very popular person if he could abate local taxes. Well, he can't. The commissioner is only involved in dealing with state taxes. Local taxes are administered by the assessors and the collectors. And again, we don't abate directly taxes that are assessed locally. That's how that is done. So again, by statute, we deal with state taxes. Now, if we go to the collector, the next slide, dealing with the bond requirements, be the one previous, I think. Yes. By statute, chapter 60, section 13, the collector has to be bonded. So you say, well, what's the amount of the bond? Well, that depends upon what your receipts are. Now, the department produces each and every year on the website in Gateway. If you go into Gateway, you can find it. It's the year-end letter from the Director of Accounts to the community. And what is included in there are the instructions. And it's included, if you want to find specifically where to get it, it would be in the end of the year letters from the Director of Accounts. And included therein is the minimum bond amounts. Now, certain officials are bonded. The collector is, as I told you, is bonded. The treasurer is bonded, and the town clerk or city clerk is bonded, and the deputy collector is bonded. In addition to that, if you're an assistant collector or you're an assistant treasurer, by statute, the assistant collector has to be bonded and the assistant treasurer has to be bonded. Now, how do we go about figuring all this out? If you are a treasurer, for example, you take a look at all the receipts that you're going to take in the course of the year, what you have on hand as of a certain point in time. In other words, retirement funds, trust funds, stabilization funds, what you're going to take in on the tax levy, things of that nation. And then you could also have a bond that's been issued by the town for the building of the new high school. And you're taking a tremendous sum of money because of that construction project. Again, that's going to factor into the amount of your receipts, what you have on hand, and that's going to lead to a higher bond. If you're a clerk, town clerk, a city clerk, you're going to get a fee based upon certain licenses and permits that you issue. And then if you're the collector, well, it depends on what kind of job you have. If you collect just taxes, you're called a tax collector. If you collect all amounts due the city or town, then what you have is you're considered a city collector or a town collector, and you collect monies from all sources. So for example, you as a town collector would be collecting on the water bills. Now, if you're an assistant collector or you're an assistant treasurer, the amount of your bond would be 1/4 minimum of the amount of the collector, or 1/4 of the amount of the bond of the treasurer. So it's again based on that. And if you're a deputy collector, it's recommended that the amount of the deputy collector bond be at least $6,500. Having said that, and before we get to the schedule itself, we'd have to say that the Commissioner of Revenue only sets minimum bond amounts. And the actual size of the bond that you have in your community is a decision that's made by the Chief Executive Officer of the community. Whatever the amount is, for which purpose is it obtained? It's protect the community in case of a loss of money. So again, that's the whole purpose of it. So under the schedule, which again is available on what is called the end of the year letter in Gateway from the Director of Accounts. If the community had a collector of taxes and takes in $15 million in the course of the year, then the minimum bond, according to the schedule, because it's the range from $10,001 up to $25 million, the amount of that bond would be what? $150,000. And 25% of that, if my mathematics is correct, the minimum bond of the assistant collector would be $37,500. Again, that's all set by the statute, and also by the schedule that comes from the department. Now, let's assume, for the sake of argument, that you are a new collector. You've just taken over, you get elected, you're taking over. The previous collector, your predecessor, has retired, getting ready to sail off to West Palm Beach, and you're taking the job. Well, when you take that job, you're going to have a situation where the predecessor is supposed to have an audit, again, by statute, under Chapter 60, Section 97. You're supposed to have an audit in order to track down the monies that are in hand and whether there's any loss, because as a new collector, you don't want to be blamed for something that your predecessor did. So that's the whole idea of having the audit. Once the audit is completed, you then have to take all the papers for the collector's office and they're given over to the assessors. And then the assessors make a recommittal of the taxes. It's called a recommittal warrant. It's done for real estate, personal property, motor vehicle excise. There's a recommittal warrant for each one of these taxes. As a result is that if you're the brand new collector, you have a recommittal bond, which you have to obtain for the, what's the recommittal? These are amounts that were not collected by your predecessor. So you have a recommittal bond, and then you have a regular bond, which would be the amount, the example I gave of $150,000. So you have two bonds when you're in the, as the new collector. You're supposed to obtain the bond within 10 days of your election or your appointment. So again, we just set the minimum bond amounts and it's up to you to do so and pick the right amount. Now, if there's a loss in your community, someone's taken money or whatever, in that case, the person who did so is at risk. Ultimately, the community is made whole, but the person who took the money is subject to a lawsuit by the fidelity company, the insurance company, and they'll go after him under a legal principle, which is called subrogation. So again, the bonding company makes good on the money, the loss, but ultimately goes against the person who took the money. And again, there are stories in the newspaper, and we're not going to belabor that. As far as the payment of the bond, well, who pays for this bond? Well, someone actually put it in a statute in Chapter 41, Section 109A, and it said that the premium on such bonds are paid by the city, town, or district. So you do not pay for the bond. The community does pay for it, and because it's for the benefit of whom? The community. It's not for your benefit, it's for the benefit of the community. So if we look at the next slide, we're going to be dealing with what is called the deputy collector. Here we are. Under the statute, Chapter 60, Section 92, the collector, unless there's a charter provision to the contrary, appoints and removes the deputy. That's all set by statute. We're not involved in that at all. Now, if you've been involved with a collection for any period of time, you can have a situation where you go through a number of deputy collectors. Well, the way it worked out was Mr. Feiner was a deputy collector in the city of Boston, and he collected all amounts that were due the city. And he then got a warrant, and they sent out notice of warrant by mail, and he actually visited the people's residences, and he made service of a warrant there, and he wanted to get paid for all his work. And there was an agreement that he had with the collector of taxes of Boston in writing that said that he, under the terms under which he would be paid. But Mr. Feiner disagreed because he wanted to get paid for all the shoe leather he had used in visiting these places, delivering the warrants, and not getting paid. And he came up and said, the fee schedule of Chapter 60, Section 15 means that I'm paid regardless of whether these people actually pay. And the court disagreed. The court said that Chapter 60, Section 15 has nothing in it about what your compensation is as a deputy collector. All it does is it lists the fee schedule. What your compensation is based upon agreement with the municipality, in this case, with the collector of taxes. And under the terms of the agreement, he would collect only where he had the warrant and he had actually taken in the money from the taxpayer. Under those terms, he would get paid. Where he was fruitless work and he got nothing, he would not be paid. So if he was replaced, for example, by another deputy collector and the taxpayer comes in and pays now, the new deputy would get the benefit of the work that had been done by Mr. Finer. And again, that's all set by statute, and that was the agreement. And again, these are fees that are made by arrangement with the deputy collector and the collector. So that's done. As far as the deputy collector, as I told you, the minimum bond amount is $6,500. Now, one of the nightmares of dealing with losses came about involving the town of Randolph back in the 1950s. There was a person by the name of Carpenter who ran a collection agency. And under the terms of his agreement with the treasurer of the Commonwealth of Massachusetts, he had to have a collection agency bond. And that's provided for in Chapter 93, Sections 24 to 28 of the general laws. He has to, in order to operate that collection agency business, he has to have a collection agency bond. But then he decided to look out for more work. And he said, I got an idea. I'm going to apply to become the deputy collector in Randolph. And he was accepted. And in 1958, he took on the job and he got a bond. And at that time, the minimum bond amount was $1,000, which he obtained. And he got it from Bond Company A. Then in 59, he got another bond from another fidelity company. That was Bond Company B. So we have two different bond companies. And that's, well, what's the big deal? Well, the big deal comes about when money's missing. Now, what happened was that Mr. Carpenter collected $4,200 that he never turned over to the collector of taxes. So now the community is looking for its money. Now, after a fight back and forth between the two bonding companies, they agreed that the losses occurred in the 2 years, each year, and each bonding company paid the minimum amount was required to be paid, which was the $1,000. So they got $1,000 from one company, and now $1,000 from the second insurance company. And now what? Well, the amount outstanding is $4,200. So the count is out $2,200. Well, no, says the town. Town attorney came in and he brought a lawsuit. And he said, we want the money in that collection agency bond, and we wanted to use it to satisfy our losses. And can it be done? And the highest court in the state said, no, it cannot, because the collection agency bond is for the business of being a collector, dealing with that particular task, not the collector of taxes. For that bond, the community has to look exclusively at the deputy collector's bond and can go to no other. So again, that was something that was done, and also it illustrates that if you have losses that cover a number of years and you have multiple bonding companies that are insuring loss, yeah, you could end up with one heck of an audit to try to calculate when the losses occurred and who is ultimately responsible for payment. And at the end of the day, the money does come. And then if there's shortage, the community loses out. And then under subrogation, the bonding company goes against the person who took the money. Now, I know when I started years ago, there used to be a thing that was called the outside deputy and the inside deputy. If you were an inside deputy, you really are now called an assistant collector. But in those days, that's how things were done. And another point is that it's about certification of service of warrant. If you're having a fee, you're going to get $17 for service of warrant. The way it works is that you send out the demand fee more than one day after it's due. And then the warrant fee is $10. And then 14 days after the demand, you send out notice of warrant, you charge $12. And then you have to wait 30 days and you have service of warrant and you charge $17. So what happens? Somebody was upset one time because instead of actually visiting the site and serving the warrant, the person mailed it. And they, according to the statute, there has to be certification of service of warrant. You actually go to the person's abode or last place of business and deliver it. And as a result of that, the department came out with a form called certification, and that's supposed to be filled up by the deputy to make certain that he's actually visited the property in order to keep the $17 fee. Now, if we go to the next slide, again, years ago, the inside deputy, now we have another title, we call it assistant collector. We have an appointment made under chapter 41, section 39C, or is determined by a charter. That's how it's done. Now, the statute has been changed back and forth. What does it say? Well, the statute is based on another statute dealing with assistant treasurers, chapter 41, section 39A. So they essentially copy the statute and put it in under 39C, designated the person as the assistant collector. What does it say now? All you have to be is a citizen of the United States. Well, is that the end of the story? Well, no, because communities do have bylaws or ordinances. And they could say that you have to be a resident of the town. And if that's the case, then you also have to be a resident of that particular community. If you're an assistant collector, you have to give an oath. And as I said, you have to be bonded. Again, 25% of the amount of the collector's bond. And the statute goes on to say that if the collector goes on vacation or is out in illness, then the assistant collector can perform the duties in the absence of the collector. Now, that's great. But what was also put in the statute? An exception. The assistant collector cannot make a tax taking. Why is that? I have no idea, but that's in the statute. Just be aware of it. I actually did see a tax taking made by an assistant collector. Is that a valid tax taking? Well, we'll leave that battle to another day. Now, going on to the next slide, we're dealing with the tax collector versus the city or town collector. If you collect taxes, only tax collector. If you collect all accounts, you're a city or town collector. Statute is going to be adopted by the legislative body. You just can't put out a new sign on front of your door. No, again, it's done by legislative body making that determination. And then if you have a situation where the collector is going to be absent for a long period of time, then the community, you can have a situation where the selectman can appoint a temporary collector or the mayor can appoint a temporary collector. And the only difference between the two is that in a city, you can only get an appointment for 60 days. But that does not preclude the mayor from making the appointment a series of 60-day appointments. If you're a temporary collector, you give oath and you have to satisfy the bond requirements. All that is set by statute in 4140 and 41 section 61A. Next slide, it deals with liens. Now this is a little bit tricky. How long does a lien last? Well, if you're dealing, let's deal with real estate, obviously, because that's where you can have a lien on property. The statute, chapter 60, section 37, says that the lien goes to 3 years and 6 months after the end of the fiscal year. So what's an illustration? How can we illustrate? Let's say we're dealing with fiscal year 19 taxes. The assessment date for fiscal year 19 is what date? 1/1/2018. The lien is a general rule. Another way of restating it is that there's a 5-year lien rule. So the 5-year lien rule runs from 1/1/18. So 18, 19, 20, 21, 22. At a minimum, the lien for fiscal year 19 taxes would expire on fiscal year, calendar year 22, December 31. And December 31 is 3 years and 6 months after June 30th of 19, which is the fiscal year in question. So that's how the duration of the lien goes. What does this mean? Well, if there's been no break, if there's a break in ownership, a sale, or which we'll get into in a moment, if there's a break in ownership after the assessment date, then the collector has to make a timely tax taking to properly perfect the lien for that year. If Johnny lives a long time and he hasn't paid his taxes for 25 years, the lien is still good because there's been no break in ownership. So again, the minimum lien rule is 5 years. Now, under the terms of the statute, the idea of the thing is to make the taking timely. And what is the procedure for the taking? I think what we can do at this time is to digress a little bit on tax takings. I think I'll put it in here. A tax taking is something that's done to perfect the lien. If you're going to perfect a lien, you can do it either through a tax taking or a tax sale. Some people, some communities go with tax sales. That is more intimidating, so the taxpayer is perceived to be more harsh, and as a result of that, maybe better able to collect the revenue from saying we're going to have a tax sale in your property. But by and large, communities go with the tax taking. Either way, you perfect the lien, you convert the lien into what? A tax title. And a tax title cannot be defeated by the passage of time and cannot be defeated by how many times the property is sold. What we said in the past is the tax title remains in effect until it is either redeemed or foreclosed upon by the treasurer. Now, if you're going to create a tax title, we're going to look at tax takings. And the job of tax taking is where? The tax collector's office. And as far as foreclosure goes, it's the treasurer's office. So again, all the legwork, everything is done, is to be done by the collector. And the collector does the tax taking for one reason, one good reason, to protect himself on his bond. Because the community can go against the collector's bond if the money is not collected, or if the money is collected and is not timely turned over. So again, by having the tax taking, the receivable is wiped out, it becomes a tax title, and he's saved on his bond. And that's all set by statute. Now, a tax sale, we're not going to cover here. It's not encouraged, because if you make a tax sale for fiscal year 19 taxes, and then the taxpayer doesn't pay fiscal year 20, you got to go back and make another tax sale for fiscal year 20, because again, there's no ability to certify subsequent taxes to the account. You can only certify when you have the tax taking process. And again, the point is that it perfects the lien on the property. It's the first step to foreclosure on the property. And again, it's something that is done for the protection of the community. As a result of that, we can say that the ownership of the property, in a sense, passes to the community with the tax title, but the owner of the property has the right to redeem it by paying off the amount that is owed. So again, if you're a collector, you're going to make a tax taking. Where does the money come from? You need an appropriation, right? Well, this is the battle with the finance committee. This is the battle of the town meeting with the selectmen. Again, you're going to need money. And if you don't get enough money to go in and collect the taxes, you have to visit your friends over in the assessor's office. And you say, listen, I can't get enough money from town meeting. Well, you make a request to the assessors, and they can raise the money on the recap sheet dealing with taxes, any amounts that are necessary. Again, that's all in the statute. And the same thing holds true of a treasurer. The treasurer can get money raised on the recap sheet if there's a reluctance on the part of town meeting to appropriate the money for work by the treasurer's office. Again, the first step in the process is you have to send out a demand notice to whom? As I try to emphasize, you send it to the assessed owner of the property. And again, you mail it, the demand is sent to the last or usual place of business or abode, or the address best known to the collector. There was one court case where the collector noticed there was a different address on a deed for the property and sent the demand notice to that address. And the court said that was properly done. The collector, the deed, that particular service of the mailing of the demand was properly mailed. Now, having sent the demand, the next step in the process is you have to wait 14 days to go. Well, now, what do you do after 14 days? Well, you can then have publication and posting of notices. And it says that you're going to do that by publishing it in the local newspaper, and you're going to post it in 2 or more public places. And if you do that, that sets up notice. And in the notice, you're going to say 14 days, no sooner than 14 days thereafter, you're going to make the tax taking at the place that is designated. Now, making a point here, everything is done in a timely manner. The statute says that if a property has been alienated, you can lose your lien. Now, you say, what do you mean by saying that the alienation of the property? How do you alienate it? Well, it's not defined in the statute, but it appears to me that in the example dealing with the fiscal year 19 taxes, if the property was sold after January 1 of 18, and we have a deed from the assessed owner to B, even if there's no consideration, we have a break, we have a deed. As a result of that, we are putting at risk our lien on the property. Another example of an alienation, if you have a mortgage foreclosure by sale or a mortgage foreclosure by entry. Again, if either of those events take place, we have a break in ownership. And again, we have to be timely, we have to act quickly. Another problem that can come up besides the property being sold is that the person files for bankruptcy. What do you do in that scenario? You get a notice from the bankruptcy court that Johnny Smith has filed for bankruptcy. A petition is there. Oh, by golly, I should go out and make a tax taking for those 19 taxes. Well, you can't do that because you'll be violating the rules of the bankruptcy court and going after the taxpayer. So what do you have to do? The collector has to file a document called a statement to continue lien, and that due to bankruptcy, and that has to be filed at the bankruptcy court. And then after the bankruptcy is over, assuming the property has not been sold and the taxes have not been paid off, then 6 months after the person has been taken out of bankruptcy, then you can go make a tax taking on the property. So again, there are all sorts of problems that can happen. So you want to be very timely and go in and make the tax taking on those fiscal year 19 taxes. So again, in your notice in the publication in the newspaper and in your postings that you make in 2 or more public places, you're going to say that Johnny Smith, the assessed owner, and maybe the subsequent owner if it's been sold, they're listed. And you're going to say that the property, describing it, let's say a 3.5 acre property is described. Again, you give the source of title that the person has for the property, and you're doing the amount of tax that is assessed, and you're going to make a tax taking. And again, it's got to be in 2 or more public postings. And again, these things are all set by statute, both as they're doing it as well as the timeline. If you violate the timeline, you got a problem. And we'll go through that in a moment. If the tax taking is made, that's what we call an instrument of taking. Once that's done by the collector, it's signed, it's sealed by the collector, and we have the document. You'll see it in the books. And it says that we give the name of the assessed owner, Johnny Smith. We describe the land, 3.5 acres, approved by a house, and the amount assessed is broken down by fiscal year. If it's more than 1 fiscal year, with incidental expenses and charges. And then very importantly, that instrument has to be recorded. I think, as I said, the fee is $105. And that has to be recorded within 60 days of the date of the taking. If you wait 61 days, you got a problem. You do not have a proper tax title. Again, so having done that, we have title vests in the town upon the recording with right of redemption in the owner. And then you give over the paperwork to the treasurer, Form 346. Now it's the treasurer's responsibility. You're off the hook as the collector of taxes. As far as the rules go for the tax titles, if there's the next year's taxes are not paid, do you make a brand new tax taking for fiscal year 20? No. As I said, if you've done it through the tax taking process, you simply certify the fiscal year 20 taxes to the tax title account. And as a result of that, everything is perfect, right? What could possibly go wrong? Well, you could have an error in the assessment. You could have an error in the taking. Well, what do you mean by that? Well, an error in the assessment would be that the individual that was assessed the taxes never owned the property in the first place. You couldn't find anything at the registry deed. The person is not even in the chain of title anywhere. So what do we do in that? I don't think there's a fee, I believe, in chapter 60, section 15 for the preparation of the documents, preparation of the tax taking, preparing there's a fee for preparing the newspaper advertisement. It's $10 per parcel. That's all set up, and all the fees for advertising, the actual cost, the posting notice, everything is all set up in 60 section 15. If you run through the list of fees, you'll see there for the preparing the deed or instrument of taking, that is $10. That's all set by statute. So again, yes, you can be charged by fees.
We have one question that came up so far. Does the town have to approve a bylaw to charge a preparation fee for the taking on or a redemption?
No, because that's all set up by statute. That's all in 60 section 15. Preparing the instrument and all that is like $10, I believe, from looking at the schedule. All those schedules are there, which is an important point, is that you're going by a fee schedule. Primary statute 60 section 15. There was one collector who said, can I charge for my new computer system and charge $84 for everybody that's in tax title because of all the work we had to go and the expense of doing a new software program? The answer is no. You can only charge the fees that are in that statute book. It'll either give you a dollar amount or it'll give you, say, actual cost. You can't make up your own fees. They're all set by statute and they're all in that list. Again, you can find that list under we do a search on our website of collection fees, charges, and penalties, or go quickly to chapter 60, section 15, and there's a list of a laundry list of everything down that can be charged by it. And again, the cost of the $105 of the recording fee, that's going to be passed on when the property is going to be redeemed. Now, on the errors go, you could have an error in a name. If there's an error in a name, you have to disclaim the taking and have the assessors reassess it. And now you got a problem because you could have a break in ownership. You could have lost the lien. That's a real terrible scenario. That's an error on the part of the assessors. And it may not be correctable. There's another thing, an error can be made by the collector. That would be an error in the taking. So for example, if you have a mistake made, you recorded the instrument of taking, you recorded it in 61 days. That's invalid. So what do we do now? You have to disclaim and start all over again. And if you do so within 90 days, you're fine. That's under 60 section 37. An error in the assessment is under 60 section 84. And that's really a problem because there's no way that anybody could find that at the registry of deeds or in registered land or anywhere else. So you got to be careful. You're at the mercy of the assessors as to what the names that are appearing on those tax bills. And the tax title, very fundamental rule is that your tax title is valid unless there's an error that's substantial or misleading. So for example, yes, without reading all the question, if you have an error in the description, you got a problem. So for example, if the error says 3,500 square feet and it really has 3.5 acres, well, there's a totally inaccurate description of that property in the assessment and in the taking. So do you have a valid tax taking? Well, probably not, because I would call that a substantial or misleading error. An example of a non-substantial error would be the name Smith. Person could be Smith spelled as S-M-I-T-H, or it could be under the English spelling S-M-Y-T-H-E. If that's Smith or Smythe, that's not considered to be a substantial error. But certainly 3.5 acre parcel described as 3,500 square feet, that is substantial, and that could really cause a problem. The good news is that most of these things can be corrected, and in the assessment side, you've got to be really quick to catch up with that error. One case came by where the error was made, and the substantial thousands of dollars had to be abated because of errors in the name. So these things can come up, you can take a loss. And then if the example we gave of fiscal year 19 taxes, and we're dealing with fiscal year 20, again, Johnny hasn't paid that either. Well, you can certify the taxes over to the tax title account, and in the statute, it says that you're supposed to do so by September 1. Some wily taxpayer came in and said, aha, you didn't certify those taxes by September 1, I don't have to pay. And the court said, ridiculous. That is merely directory language in the statute. It's not mandatory. And therefore, as long as you properly certify it over, it's entirely done in a proper way. Again, the idea of the thing is that everything is handed over to the treasurer's office, and the treasurer is responsible for the foreclosure and collection of the amount. And then as far as the installment of the tax title, as I try to emphasize, again, you can have a payment plan, and the treasurer can extend the foreclosure period for 2 years. If there's a property is redeemed from tax title, then the treasurer issues what is called a certificate of redemption. And then the redemption certificate should be recorded by whom? By the treasurer. Why? Because we don't trust the taxpayer. We're going to get the fee from him for the recording of the redemption certificate. We march down to the registry of deeds. We make sure it's recorded, and we notify the collector and the accountant of the redemption. So everything has got to be done in a proper way. If the property is not redeemed and the land court issues a decree of foreclosure, the taxpayer has 1 year from that date to record the property. That's set out in the statute. I believe it's chapter 60, section 69A. Again, that 1 year period. After 1 year, the door closes unless there's been a due process error in the taking. Now, the point is that when we're going to foreclose on property as a treasurer, 99% of the time you're going to use the court. And the land court is exclusive jurisdiction, and you have to get the decree of foreclosure from the land court. That's the only place you can go to get it. There is another provision called land of low value, and that's what we deal with at the Revenue Department. And that's where the property is not worth more than $23,182 for calendar year 21. So again, with a, let's say, roughly $24,000 valuation, you really are dealing with low value. If you're dealing with low value property, the treasurer can auction off those properties using what is called a land of low value procedure, which we won't get into here. Again, that's done in conjunction with the Revenue Department. And that particular thing is an affidavit from the commissioner, a recording of statements, recording of affidavit. And what is the foreclosure? The foreclosure is by public auction. The foreclosure that 99% of the time you'll be dealing with is what we call a judicial foreclosure through a court of law, specifically being the land court. And again, if the property then becomes a tax possession, meaning it's not redeemed, it's not claimed after a year, you have a tax possession custodian that comes into play, and the tax possession custodian could ordinarily be whom? It would be the treasurer of taxes, treasurer in the particular community. Again, as a point of view that there's a lot to liens. We went through, going back to our chart here of the liens itself, you could have a utility lien on property, a water lien, if you have bill at least water bills twice a year or sewer bills twice a year, and the bills are unpaid, you can add those bills to the real estate tax, right? Obviously, because we have water lien committed and water lien committed interest. And how do we go about doing that? Well, the best way is through an example. Let's assume that the town, you're the collector of taxes for the town or the assistant collector, and the community has accepted the relevant statutes dealing with water liens and sewer liens, and you issue water bills, sewer bills twice a year. And you issued a bill, for example, on November 15th of 2020, and you issued the second bill on May 15th of 2021. Now, the bills, the first example, the first bill is due December 15th of 2020, and the second bill is due on June 14th of 2021. So everything is coming in place in fiscal year 21. So if then bills are unpaid, then we can have a lien for those unpaid taxes onto the fiscal year 22 tax bill. But it's not as easy as all that. You're supposed to act timely. If you don't add those unpaid water liens and sewer liens to the fiscal year 22 bill, you could have a problem. Because if you did it right way, the lien for the water liens would last as long as the lien for the real estate would be, a minimum of what? 5 years. But let's say the water department doesn't notify you timely. Well, then we don't add it to the 22 bills. That means that the lien only lasts 3 years and not the full 5 years. So if it's not timely added, and then the lien for the bill that was due in December of 2020 will expire in October 1 of 2023, and the lien for the bill due in June of 2021 will expire October 1, 3 years later, 24. You say, by golly, that's a real workout. Can it get worse? Well, you could have liens for water, sewer, electric light, and the electric light can be for a plant located in another community. What about trash fees? Yes, the lien arises by operation of law. Now we have a situation which is explained in a guideline release, IGR 2021, section number 13, where you can have sewer service provided by one town to residents who reside in another town. An example of this would be the town of Hardwick supplied sewer service to a parcel in New Braintree, and the bills are unpaid, and the town of Hardwick wants its money. So what it could do is it accepts provisions in Chapter 83, it files a certificate of acceptance in the Worcester Registry of Deeds, and sends along a copy of the certificate to the New Braintree tax collector where the property is located. And that means that the town of Hardwick, for the unpaid sewer bill, can put a lien on a property which is located in New Braintree. And then the tax taking would go into effect as far as it goes. Other communities have done the same thing through special legislation, where Natick, for example, supplies sewer service to the town of Wellesley, certain properties there. And it allowed the Wellesley to add the unpaid sewer bills that were not paid to Natick onto the Wellesley real estate bill. And when collection, the money would come in back to the town of Natick. So again, there are all sorts of rules that govern unpaid liens. If we go to our next slide, the Municipal Modernization Act did one thing. What it did is it made everything be in the same step. What does that mean? If you're late paying your semi-annual bill due November 1 and you pay it on November 5th, you only owe what? 4 days worth of interest. The interest is only for the number of days that you're late. It doesn't go back to a penalty provision back to October 1. So again, if you're late paying, you're measuring from the due date onward. As to our next slide, as far as payment goes, it's actual receipt by the collector. If you overpay, the elderly taxpayer pays his May bill twice. Does he get interest? No, he gets a refund of the second payment that he made without interest. Sometimes questions come up where property is sold, bills are overpaid, where does the money go? Well, again, you get a payment made by the buyer, payment made by the seller, payment made by buyer's bank, payment made by seller's bank. Who's entitled to the money? Well, as far as the overpayment, make real sure to whom you're supposed to make the payment. As we said, wait for further instructions. If you're going to have an abatement application filed and the person is entitled to a refund, well, is that always the case? No. If you have a tax first half bill paid February 1, and then the second bill is due May 1, and that payment has not been made, an abatement application is filed, granted by or approved by the assessors, then ordinarily where does the over abatement go? You apply it to the second half bill, which would be the May bill. The only time that you would have a refund is when for the commitment for the entire year has been overpaid, the entire year, because the May bill is only an installment of the actual bill that's broken up into two pieces. So again, if you do have an overpayment of the entire year, you do get interest at 8%. What's the source of the interest? The source of interest is the overlay account. So you have no excuse not to make payment of interest. And you say, well, how do you measure it? Well, if you're dealing with an ordinary abatement, leave it under 5969, you're measuring it from the date of payment or the due date, whichever is later. And if the appellate tax board gives the abatement and refund to the person, then that's measured from the date of payment under 58A, section 13. So you say there's different sets of rules depending upon the entity that granted the abatement. So again, that can be confusing. Let's go to the next slide. Well, what about collection remedies? We have 5 of them. We talked about tax taking. There's also denial of local licenses and permits, local option. The third is a municipal charges lien. We'll deal with that. There's a thing called set off. What does that mean? And then we'll deal with a lawsuit. And again, these are all things that are done. Important point is, if you're a collector of taxes or you work in the office and you know that Johnny's coffee shop is out of business and Johnny has moved to Florida and you can't collect that money, well, that's an uncollected personal property bill. Then the collector, under oath, notifies the assessors, we cannot collect these personal property due to death, poverty, bankruptcy, insolvency, inability to locate, whatever reason. Then the assessors review the list, make a determination what to do, and they can abate the ones that they like. And that's done under what statute? Chapter 59, section 71, dealing with personal property only. Now going on to our next slide, the tax taking, we belabor that. That's all done. We know the rule on that. Now going to the next slide, we're going to do the remedy of local licenses and permits. This allows the city or town to establish rules saying that if you don't pay your taxes, we won't give you certain licenses. It's a local option statute. The community has to have a bylaw or ordinance enacted in order to make it work. The statute says it applies to applicants not currently in good standing. What does that mean? That's a rule that you have to make in your particular community. The collector notifies the various departments and says, listen, Johnny is a deadbeat. We don't want you to give out certain licenses to him unless we get good money. Is that easy done by the selectmen? Well, no, it's not as easy as you think. Example is a person owns property he hasn't paid his real estate tax. There's a restaurant operating in the building. Now, if you deny the restaurateur his license, that means the restaurateur is not paying rent to the owner of the building. If there's no payment of rent, how does the owner of the building pay his taxes? So again, you have to have certain discretion allowed in the denial of licenses or permits. Going to the next one, we deal with the municipal charges lien. This would be a case where you have to have a vote by the town meeting. So for example, false fire alarm done at the certain warehouse complex. The fire department is going crazy. 2 or 3 times a month, the alarms are going off. They want to charge what is called a false fire alarm fee because of risk to firefighters and equipment. And we say that can be done. Now, what's the difference between this and the water lien? Water lien, if it's unpaid, the lien arises by what is called operation of law. With this particular charge, which I call, make it up, a false fire alarm fee, if it's unpaid, the collector has to record a list of the taxpayers by name and parcel with the amount. And then having done that, that's how you create the lien, by recording that. And when payment is come, you have to discharge the lien. One collector of taxes came out with a list of, let's make it up, 27 parcels on a sheet of paper and brought it down to the registry of deeds to record. She thought that the recording fee would be for the one single sheet of paper. She was stunned. At that time, this happened a number of years ago. She ended up getting a bill for $2,700 from the registry of deeds because the fee is applied to each line on that sheet of paper. So as a result, you multiply it out. So what does that mean? Well, that means if your community is going to be gung-ho, as this community was, on adopting all sorts of municipal charges, valid or not, again, there has to be some connection with the property. You have to have enough money as a collector to record the instruments at the registry of deeds. I think if we go to the next slide, we deal with set-off. Set-off means that you're going to withhold money to a taxpayer where the taxpayer owes money to you. There has to be identity of parties. Very critical element. If somebody is in a business, the XYZ construction company is looking for a building permit and Mr. Smith owns the company, but Mr. Smith is delinquent, not the XYZ company. Well, that's not an identity of parties. So again, what's an example? Bank of Boston 5-cent savings bank had acquired property through foreclosure, multiple properties, and paid taxes on the good properties, did not pay taxes on the bad properties. And what happened was the bank filed for abatements on the good properties, got abatement refunds, thought they were going to get them. And what happened? The collector said, don't give that money to the bank. We want you to apply it to the unpaid real estate taxes on these terrible properties. Court said, yes, it can be done. Another example is Dakota v. Town of Stoughton. Person-owned properties, developer, town made an eminent domain taking on property. And if you're familiar with eminent domain, this pro tanto award is given to Mr. Dakota. He challenged it, took it to court. He got a big sum of money from the court for the properties that were taken by eminent domain. The treasurer said, wait a minute, you're not walking away with that money because you didn't pay your tax titles on all this list of properties. So as a result of that, it ended up that the refund, the eminent domain award was used in order to pay off the taxes. Again, there's no statute of limitations on set off. It could be over 6 years old, no problem. The next remedy is dealing with lawsuit. If you have unpaid personal property tax, your best avenue is what? A lawsuit going into small claims court, regardless of amount. And then if there's an unpaid real estate tax, you can also go there up to $15,000 in taxes. Bear in mind, the taxpayer has a right to remove the claim over into Superior Court. But again, that's something that is there. If you have the situation of a bankruptcy, you get a notice from the bankruptcy court, which is our next slide. You're going to have to it's governed by federal law, by the federal bankruptcy court. There's an automatic stay against going after collection. As I try to emphasize, where the property was not in tax title, the automatic stay says you can't even send the taxpayer a demand notice. So what do we do with that? What should you do? Well, you file what is called a proof of claim with the bankruptcy court, and you want to get the money for that. As far as my understanding, you can go back 3 years on excise taxes, and you can go back 1 year on personal property taxes. Again, that's done through the bankruptcy court. We mentioned in the next slide, the statement to continue municipal lien. There's a bulletin on that. It's bulletin 2017-03B, which explains the procedure. We now have a new title, and the ledger of the town accountant is called Taxes and Litigation. And then after the person has been discharged in bankruptcy, then the collector 6 months later can go in and make a tax taking on the property. On motor vehicle excise, which you're going to hear at great length, I think the important point on it is, again, that I told you there's the webinar, which is available. If you go to our YouTube channel, we've got to mass.gov/DLS. You go to scroll down, go to our YouTube channel, you'll see a category of things called webinars. And the webinar we have is called Motor Vehicle Excise Webinar, Tuning Your Motor Vehicle Excise Skills. It's given by Chris Wilcox, who's the Bureau of Local Assessment Chief. But what I find of interest, even though some of our records are not up to date, it's rather interesting to note that there are at the moment that the list was prepared, we had 5.6 million registered motor vehicles in the Commonwealth of Massachusetts. That's a heck of a lot of cars. And there is over $900 million annually collected in motor vehicle excise by the 351 cities and towns. The important point is that motor vehicle excise is a tax upon an event or privilege. The privilege is the privilege of registration. Years ago, up to 1928, cars were assessed as personal property. They're now assessed as what? Under excise for the privilege of registration. You're going to go through that at great length. I don't think we have to belabor it. The important point is that the tax was challenged. A person said, you can't do this to me. It's unconstitutional. And the court challenged his excise bills. He owned a fleet of trucks. He said, listen, I got dealer discounts. I got manufacturer's discounts. I paid less than appears on this bill as a value. The court said, regardless, we're going with standardized value. We're not going by what it, first of all, it's not an ad valorem tax. It's not based on the value of the vehicle. It's based on standardized values for all that kind of truck. And again, if it was based on what you paid for it, it would be a sales tax. We're dealing with standardized values. It's upheld. It's constitutional. When did the court come up with this? 1998. That's all that's been done on that. So I think we're going to go ahead and lengthen that in an hour. We'll go to the next slide, which is boat excise. We could say that boat excise does exist. It's based on the length of the boat, the age of the boat. The maximum charge is $500. Half the money goes into estimated receipts. Half the money goes into the Waterways Improvement Fund. It goes to things like police and fire for the harbor master. It's all set out in statute. It's not a local option tax. By my count, we have 5 minutes left. And in 5 minutes, what can we possibly do? Well, we can do our quiz. Are you ready? Number one, can the Commissioner of Revenue directly abate a local tax? No, he can't do that. He'd be abating my bills if that were true. And he isn't doing that for me. So he can't. The answer is no. Is there a statute of limitations on the collection of local motor vehicle excise? No, there is a limit on the remedies to collect. The bill never goes away, okay? It never goes, there's no statute of limitation on collection. You can come back after 20 years in New York. By golly, you're going to get that interest. Okay, go to number 3. John Gage was the assessed owner of a house as of January 1, 2007. A portion of the fiscal year 2008 real estate taxes remain unpaid. There is no tax title, and Gage is still the sole owner. Can the collector make a tax taking? Yes, because there's still a valid lien. There's no break in ownership. The answer is yes. 4, a discharge in bankruptcy bars any lawsuit against taxpayers personally to collect payment of the taxes from other assets they may own. The discharge in bankruptcy does not prevent the municipality from enforcing its lien on the subject property. True or false? The answer is true. Go to number 5. Does an error on a municipal lien certificate render the tax uncollectible? The answer is no. You still have personal liability. You're still subject to a civil suit, for example. The answer, no. 6, a tax taking perfects the lien for the unpaid real estate tax. The answer is true. It perfects the lien. 7, collectors and assistant collectors are bonded to protect municipalities from law. True or false? True. Can a builder be denied permits for a planned subdivision if he owes taxes on other property in town? Yes, if 40 section 57 has been accepted. 9, what is the most effective remedy available to a collector if taxpayers fail to pay their personal property tax bills? The answer is civil suit. Go to court, small claims court. 10, the collector issued a municipal lien certificate which did not disclose the tax taking on the property. The lien certificate was duly recorded. Did the municipality lose its lien on the property? No, the tax title is on record of the registry of deeds, specifically stated in 60 section 23. The world is on notice. 11, even if the property has been sold, the collector must send the demand to the seller, the assessed owner. Is that true? Yes, it has to be sent to the seller under 5911 and 60 section 16. Go to 12. A warrant must be issued and a warrant must be served before the collector can mark the delinquent taxpayer at the registry of motor vehicle. True or false? True, as you'll find out. Wright v. Collector of Taxes of Arlington, going back to 1994. It's a prerequisite to notify the registry that you do this. True. 13, by filing a timely abatement application, a taxpayer can prevent the collector from pursuing collection. True or false? False. 15, an assessor cannot hold the office of collector or deputy collector. True or false? True. Found in 41 section 24. 16, in what court does the treasurer file a tax foreclosure petition? Land court, section 6, chapter 60, section 64. 17, a new homeowner complained to the collector that he never received his fiscal year 2022 real estate tax bill. Can the collector waive interest and charges? First of all, you got to be in a good mood that day. And therefore, the answer is you could be in a good mood, but if the amount is $15 or less, you could do so. But if it's over $15, the answer is no. Chapter 60, section 15. And with the real estate bills getting bigger and bigger, I think that you're going to exceed the amount. And the answer, I think, would be no. 18, and secondly, it's discretionary. 18, the taxpayer made a partial payment on his delinquent fiscal year 2022 real estate tax bill. How should the collector apply the payment? You apply it to what? Interest, collection cost, and then the tax. Chapter 60, section 3E. 19, what is the name of the statutory remedy which permits a treasurer to withhold payment of any money payable to any person who currently owes taxes, assessments, or other charges to the municipality? The answer is set off, found in chapter 60, section 93. 20, if a taxpayer files for bankruptcy, his excise taxes are discharged. True or false? False. We're going after that money. So I think that sums it up. And we have exactly 30 seconds left. Could anybody possibly have a question?
There is one in the chat, if you want to read that one.
Okay, what does it say? Chat.
Are there
Um,
rules and write-offs for general billing? Particularly, we have a general billing for police extra duty where business just filed for involuntary dissolution with the Secretary of State. Can we write this off, or should we have collector/civil suit be used?
Well, I said, well, it shows number one that on the police billing, it shows you that, as one official told me, get the money up front. And that way you don't run into the problem. Get the money in advance for the police detail. You may not be able to collect that money, because the only way that you could collect it would be through civil suit. And then if it's an involuntary dissolution, you might try. The only thing I can think of is you have to go through a court proceeding. I don't think there's no ability, or if he owns property, there's a way to do real lawyering, and you try to go against a claim against the property. But again, if it's a company that was this rented property, it was incorporated, it's dissolved, the person's gone, he's off the scene, the bills are unpaid, yes, you end up with a situation where it's technically not collectible, but it sits there as an unpaid bill until it's resolved. And again, it may not be collected at all. You lose out, as you can't really tack it onto a real estate tax. Any questions beyond that? Get the money up front.
I just want to thank Jim. I can't believe he did 15 slides in like 10 minutes. It was incredible. Your wealth of knowledge is amazing, and we really appreciate all your help on this. And he also teaches at our annual school, and he's there at the DLS if you have any questions, and look on his website that he mentioned, because there's a lot of extra information there. We
I
have
would just
50
like to add,
You can
Jim.
email it, or you can, if you want to call me on my computer phone, assuming my computer phone works, and you know how the state is, sometimes it doesn't function, but it's 617-626-2451. Call up and ask the answer man, what's the answer to this situation? And if I know the answer, I'll find it out and I'll get back to you.
So I would just like to add, thank you to Jim. Does Jim do a good job? True, absolutely does a great job. So, Thank
Try to
you.
make it fun. I think it's you try to work with your people, and you try to make it a pleasant day. And we try to, it's too bad we couldn't get out of the office and have a leisurely lunch, but maybe next time we could do something different. But you've been kind, and the organization is good to me. And I've enjoyed going to Dudley, Massachusetts, driving down all those places, no problem whatsoever. And I want to thank you, Chris, and I want to thank you, Beth. You've been very good. I guess I now get the excuse to log off. And I want to thank you very much for your kindness and hospitality today.
Thank you. Everyone has like a 15-minute break. You can just turn off your video if you want and come back in instead of having to log off. So I appreciate all of your patience with everything, and we will see you in 15 minutes with Ron.
Very good. Thank you, Beth.
If you need me at all before 11 o'clock, am I going to be sharing my screen, I assume?
Yeah, let me just see.
My share screen is turned on, so I don't think there's anything you need to do.
Okay, you're great then.
So let me just practice. Oh, no, you disabled participant screen sharing, so I think you do need to make me a host. Right now?
Yeah.
There we go.
So when we do our next one, we have to just make sure that we go back so I can do Ellen's.
Okay. Can you just do me a favor and just, I want to make sure, I've got two monitors and I can never tell which one is the right one showing. So it should be showing a view of the Arno River in Florence.
Correct.
You know what you're seeing?
That's what I see.
Okay, awesome. We'll stop share. Okay. Want to make sure I share the right screen.
I just couldn't believe he went through so many slides so fast at the end.
I saw him at slide like, it was after 10 and he was at slide like 11 of 31. I was like, oh, he's like gonna get cut off or he's gonna rush through the rest. But no, he did a good job. He did a great job. So I don't have as many slides. I only have slides. 23. There's gonna be plenty of time for questions.
Great. It was funny
All right.
because I was really worried. There's like, I have so much time on one person, but I didn't realize the subject matter. Yours is a much smaller subject versus his was like everything in one.
Yeah, he went over everything. So you said somebody was gonna introduce me?
Yes. Wendy Graves.
Ah,
Yes, that
okay.
would be me.
Hi, Wendy.
Hi, how are you?
Okay.
Put on my
I guess
screen.
we'll meet up again at 11 o'clock.
Yes. Hi, Wendy.
Hi.
Hi, Wendy.
It was funny
Alright.
when I tried to mute people, somehow I lost the screen. I had something else and then I had to go back on. I don't think he kept talking through it also. It didn't matter.
As far as questions are concerned, are we just going to continue with the chat?
Yeah.
Let
If
people-
Wendy, if you see something in the chat and he misses it, you can just say, Ron, there's a question from the group, whatever. So,
I've got the two monitors, so I should be able to see the chat, but if somebody else
okay.
monitored as well, and if I look like I'm moving beyond the question, then just interrupt me.
Wendy, I was looking over the schedule for the treasurer one in a couple weeks, and some of them are like 45 minutes, like, and then the one for payroll is like 2 hours. So I don't know how that happened. And I
Yeah,
wonder, if
payroll
we-
is a lot. There's a lot to go over on payroll.
so it makes sense they keep it that way.
hmm
We have our two experts anyway. Ron and Jerry are doing it.
And people usually have a lot of questions on the payroll one too.
That's why it's the end of the day too,
Mm.
because I
Mhm.
figured that if people go over, it won't ruin for the other person after. I'm going to take a couple second break. Wendy, I see like one more minute, then you can just introduce Ron.
Just to double check again on the sharing, are you seeing my, just the introductory screen of the presentation?
Yeah, it says
Okay,
motor
you're not
vehicle.
seeing other stuff, okay. Hyper paranoid about sharing the wrong screen. Wendy, do you want me to pause sharing while you introduce?
Oh, it doesn't matter to me.
Okay.
Just tell me when you're ready.
To do it now if you want. I don't think anyone got off, so I have as many people.
Yeah, it looks like 88. So good afternoon, welcome back. It's my pleasure to introduce Ron Mendes. He's the treasurer collector for the city of Newton, and he'll be speaking on motor vehicle excise tax. I'm also asking everyone to mute themselves so they won't disturb the presentation, and also turn off the video if you have a lot of distractions in the office. Thank you and enjoy the presentation.
Thank you, Wendy. The way we're going to handle questions, you're free to put any questions in the chat as the presentation moves on, and I'll monitor the chat here, and somebody else will monitor the chat, and we'll try to make sure we get to all the questions, as the presentation is going along. Or if you have something at the end, feel free to put it in the chat at the end as well. So without further ado, this is a presentation on motor vehicle excise. And so we're going to kind of take a little bit of a deep dive, but this is an introductory course as well. So there are some fine points that are not going to be covered in this class that will be covered in more of an advanced class, but we should be able to get all through all these slides and through everybody's questions as well, and might even have a little time left over at the end. So without further ado, I will start with an introduction. So every owner of a registered motor vehicle is required to pay an excise. We refer to it sometimes as an excise tax. We refer to it as an excise, but it's essentially a tax. And this tax is assessed every calendar year. And that's an important distinction to make because most of the other taxes that we assess and collect are collected on the basis of a fiscal year. But with excise tax, they're assessed on a calendar year basis. And most of you are going to be seeing the so-called first commitment. Commitment is, if you haven't heard that word before, it's a municipal finance ease for a batch of bills that gets. So most of us are going to get our first commitment within the next few weeks. And the first commitment is usually the largest commitment. So in the city of Newton, we issue somewhere in the ballpark of 60,000 excise tax bills a year, and probably about 45,000 of them are going to be mailed within the next few weeks with that first commitment. And then throughout the rest of the year, the Registry of Motor Vehicles usually issues smaller commitments to cities and towns to issue excise tax bills as people buy vehicles throughout the year. So they'll get more of an apportioned excise tax bill. So if you receive an excise tax bill in, for example, the year calendar 22, it would be for, if you bought the car in fiscal 22, you would get a prorated excise tax for the amount, for the number of months that the vehicle was registered. And that's another important point, is that it's important to keep in mind that it's the registration of the vehicles, getting the plates and getting that car registration is what triggers the excise tax. So every motor vehicle and trailer is registered in Massachusetts, gets a tax if it's registered in Massachusetts. And as Jim Crowley mentioned in the previous video, there is a couple of YouTube videos that the DLS has put out on excise tax. I put the link here. Obviously, you can't click on the link. But I also have a, so if you go to YouTube and you just put in the search, Mass DLS Motor Vehicle Excise Tax Mass or something like that, you should get the videos. They're on YouTube. They're available just by logging on to youtube.com and doing a search to find them. There also is a link on the state website, but I went to the link. I did see that it pretty much just brings you to YouTube. So you have to do this anyway. So there is other resources to review if you would like to. So the first question, earlier I said that excise taxes are assessed to motor vehicles and trailers. So the question is, what is the definition of a quote unquote motor vehicle? So this is the definition. I pulled this from the state website. There is, if you look up the state website, there's a lot of obsolete language that's used that you might notice if you look at some of the references on the state website. So motor vehicles are defined as all vehicles constructed and designed for propulsion by power other than muscular power, so no wheelbarrows, including such vehicles when pulled. So that includes trailers, and it includes anything else that's being towed or pulled by another motor vehicle. It does exclude, however, trains and trolleys, including what they refer to as trackless trolleys. Today we call those buses. Vehicles are also used, vehicles that are used for purposes other than transporting property and that are capable of being driven at a speed of more than 12 miles an hour, and that are either, so in order to qualify as a motor vehicle, it has to have the capability of driving more than 12 miles an hour, is basically what this is saying, to qualify as a motor vehicle. So if it can only go less than 12 miles an hour, it's not going to qualify as a motor vehicle. And it can't be used exclusively for building, repairing, maintaining highways. So that would be the big, large equipment. and that's owned by the state because there's highways. And it also has to be designed, especially, it can't be designed specially for use elsewhere than on the traveled part of ways. So golf carts, for example, don't get motor vehicle excise tax because those are not designed to be traveled on roads. Wheelchairs, of course, owned and operated by disabled persons, are exempt from being qualified as motor vehicles. They're not taxable. And but motorized bicycles, aka motorcycles, are taxable. Well, motorized bicycles, you know, that's probably what they're getting at is motorcycles are taxable. Motorized bicycles are not quite an AKA. Motorized bicycles are essentially bicycles that can't travel more than 12 miles an hour. So it goes back to that 12 miles an hour rule. So it's going to be a motor vehicle or a trailer to be taxable. If it is taxable, then the next question taxpayers might ask is, how do I get out of it? How do I reduce it? How do I mitigate it? And that is through the abatement and exemption process. So if a tax bill is issued, that's because we received a file from the Registry of Motor Vehicles that listed their car registration and listed an amount due. The registry calculates the tax. They simply send us a data file. We download it into our billing system and we issue the bills. Then the taxpayer gets the bill and they might decide they don't want to pay it, or they want to mitigate it, or they want to do whatever they want to do. So the first step is to see if they qualify for any kind of abatement or exemption. If they want to file for an abatement or exemption, they can do so with the assessor's office, and that is done using an abatement application form. The abatement application form is available on mass.gov on the state's website. It's also available in paper form in all assessor's offices, and usually online as well. It's a standard form. They're supposed to file it within 3 years after the excise was due, or 1 year after the excise was paid, whichever is later. What happens if the assessors issue abatement after these deadlines? It's still abated. So I don't know that we can necessarily hold the assessors to this, but the assessors could use these deadlines as a reason to not abate a tax that is extremely old, or certainly not something that was paid 20 years ago and somebody decided all of a sudden they want an abatement. So there are reasons why the assessors say they're not going to grant an abatement, but if they do grant an abatement and we get an abatement certificate, then we are required to honor it. Filing an abatement and an application does not mean that collecting the excise has stopped. And that's an important point. When somebody files an abatement application form, that doesn't stop the interest from accruing. It doesn't stop us from sending demand notices or warrant notices that we'll get into in a minute. It does not stop the collection process. The only thing that will stop the process in its tracks is the Board of Assessors itself issuing an abatement. Taxpayers may also file an abatement if they're the spouse of a qualifying person. So if the vehicle is owned by somebody, their spouse can apply for an abatement. If the vehicle is jointly owned, or the surviving spouse of a qualifying person, or the executor or administrator of the estate, if the taxpayer that was named on the bill is deceased. Again, abatements can be either there's a long form and there's a short form. I won't go into that. That's more for the assessors to be concerned with. Again, they have 3 years after the due date or a year after the excise tax was paid, whichever is later. So if somebody paid their excise tax 5 years after the due date, so they paid 5 years late, then they have until 6 years after, because they have a year after it was paid to file an abatement application should they choose to do so. Again, filing an application does not mean collection has stopped. That's an important point to make. Sometimes people will come in to the collector's office and say, well, they filed an abatement application, so we can't do anything. And that's actually not the case. We have to receive the actual abatement approved by the Board of Assessors. Assessors have 3 months, generally speaking, assessors have 3 months from the date they receive an abatement application to act on it. If they do not act on it, it is deemed denied, which is essentially another way of saying if they don't act on it within 3 months, then things just continue as we were going along to begin with, because again, filing an abatement application doesn't do anything as far as our activities as the collector's office is concerned. Okay, some valid reasons for an abatement as opposed to an exemption. There are abatements and then there are exemptions. So some valid reasons for an abatement could be you moved outside of Massachusetts. So if you moved to another state, say Colorado or something, in the middle of the year, you could contact the assessor's office, file an abatement application, and have the excise tax for the year prorated and be entitled to get a refund of a portion of the year. You may have moved from the city or town. If you move from one city or town to another city or town, in theory, what you could do is request an abatement from the first city or town, and then the assessors should then recommit the remaining part of the year to the new city or town for the new city or town to send a bill for the rest of the year. That's typically how moving from one city or town to another works. They could also just simply not file the abatement in the first city or town. They won't get a replacement bill for the remainder of the year unless it's recommitted. So there won't be a bill from the registry if you change your address and all of a sudden you're in a new town. The registry won't send a new bill to the new town until the following calendar year. You could also file an abatement if you believe the vehicle was overvalued, but overvalued is a very the likelihood that you're going to have an overvalued vehicle would have to mean that there's some error that took place at the Registry of Motor Vehicles with regard to the values that came out on the bill, because it is, as Jim alluded to during his presentation, it's very strictly construed that the statute provides exactly what the value is supposed to be, and we'll get into that in a few minutes. If the vehicle was stolen, then you can file a police report and you can attach that police report to your abatement application, and that should be a reason to get an abatement, or at least a partial abatement. And if you re-register the vehicle, if you get new plates, then in theory, what you can do is, if you get a bill for the new, under the new registration, so if you, for example, you have an excise, you have a registration, a standard registration, and you want to get a vanity plate, and you get a new registration with your vanity plate logo, whatever it is you put on the new plate, you might get an excise tax bill because the new registration triggers a new excise tax bill. If you get another registration for that the rest of that year, then you should be able to get an abatement on the original bill. So again, if there are any questions throughout this, feel free to just type them in the chat and I will answer them as I see them pop up. So there are individuals and organizations that are exempt from getting an excise tax bill. And sometimes these entities may or may not come through the data files that we get from the Registry of Motor Vehicles. From the Registry of Motor Vehicles. So obviously the United States government and all of its agencies are exempt. The Commonwealth of Massachusetts and any political subdivision of Massachusetts. A political subdivision is a city, a town, a district, a water district, a retirement system, any of the entities that exist throughout the Commonwealth. And I'll give you an example. When I was the collector in Wilmington, I was the collector in another community. There was an FBI agent that lived in town and had a U.S. government-owned vehicle that was principally garaged in Massachusetts with Massachusetts plates, trying to be sort of a unmarked vehicle, but it was owned by the government, and the registration came through addressed to the FBI. We had to look for that because we had to make sure that the assessor accept that, because when you send a bill, an excise tax bill to the FBI, it would be nice if they filled an abatement application out, but they don't. They just simply say, we're the government, you can't tax us. They throw the bill in the garbage. So we would have to look for that, and we'd have a conversation with the assessor's office, and we usually ended up, the assessors would abate that. They would find a way of abating that. You also have to be concerned when you get the data file with any mostly vehicles that are owned by the city or town itself. So you'll get, and I know with the city, we own hundreds of vehicles, and we get, we need to make sure those get either exempted or deleted from the file, or however we handle it. Each city and town has its own way of dealing with how you manage these exemptions, but we don't want to be, necessarily holding the city or town itself to excise tax bills that they're exempt from. Charitable or religious organization whose personal property is exempt are also exempt from the excise tax. So if they are exempt from the personal property tax, for example, a church or a convent or a monastery or organization that would otherwise be exempt, if they get an excise tax bill, then they can file an abatement application with the assessors. The assessors will review their status, and if the assessors agree that it's exempt, then they will issue an abatement certificate to wipe away the tax bill. But again, not our role to make that determination. It's our role to point them in the direction of the assessor's office. The assessor's office makes that determination, and we act based on whether or not we receive an abatement application from the assessor's office. Lessors engaged in the business of leasing motor vehicles if the vehicle is leased for a full calendar year to a charitable organization. So this covers, if a charitable organization that would be exempt leases a vehicle. So if you have a church that leases its pastor's vehicle from, Chase or something like that, or some Hyundai, whoever, that vehicle is exempt because it's being used for that charitable organization. So the leasing company would have to file the abatement application. And again, the assessors would make that determination. So-called Section 5 plates are exempt as well. Manufacturers, farmers. That's a subject for a more advanced. This is more of an introductory excise tax course. So, but just note Section 5 plates are treated in their own way. And going on, former prisoners of war and their surviving spouses are allowed to have one exempt vehicle if I believe this is a local option. So if the city or town has adopted this local option, then it allows former prisoners of war or surviving spouses of former prisoners of war to have one exempt vehicle. Disabled or blind veterans as well. And I won't go into this too much, but these are just some individuals and entities that are exempt. Massachusetts service members, this is one that comes up every now and again. So if you have a member of the military who is normally domiciled in another state, but they happen to be stationed in Massachusetts, and because they're stationed in Massachusetts, they have a car with a Massachusetts plate, federal law actually doesn't allow us to tax them, so they can get an exemption as well. Disabled or blind people are also allowed to have one exempt vehicle that doesn't get taxed. And again, under federal law, I mentioned this earlier, service members that are stationed in Massachusetts. The other one was Massachusetts domiciled service members that are serving overseas. So if you have somebody that is a service member that is from Massachusetts, they have a Massachusetts registered car, but they're serving overseas with the military, there's an exemption that could apply. Again, the point for us as collector's office staff is that we point these people in the direction of the assessor's office if they have any question. And it's good for us to just know what the possibilities are, so that if somebody does raise that kind of an issue, then we know you probably should go to the assessors and have a conversation with them to make sure that if you have any exemptions that you're entitled to, that you get the benefit of those. So that's a little bit about abatements and exemptions. Now we'll talk about actually how the excise tax is calculated. So the tax rate statewide applies to all cities and towns. Unlike the property tax, which is different in every city or town, the excise tax rate is the same. It's $25 per $1,000 in value, otherwise known as 2.5% of the vehicle's value. The value we'll get into on the next slide. Again, it is a calendar year-based tax, not a fiscal year-based tax. So it's billed by the community where the vehicle is principally garaged. And where the vehicle is principally garaged is one of the fields that the registry motor vehicles maintains in their database on the car registration. It triggers where the excise tax goes. It also triggers their insurance because different communities have different insurance rates. So it also determines their insurance status. Just to give you one example, I had in a town that I worked in previously, prior to Newton, abutted a larger city, and we had one individual whose house was right on the town line, but their driveway was in the town, their house was in the city, and they, even though their address was in the city, their front address, they argued with the registry that because their driveway was in the town, that they should be considered principally garaged in the town. So registry ended up agreeing with them, and they did it for insurance purposes because the town's insurance rate was lower than the larger city. So they got the break on the insurance, but the town got to collect their excise tax because their property straddled the town line, and their driveway happened to be where they kept their car happened to be in town. So it can sometimes get very technical in terms of where the car is principally garaged. If a motor vehicle has been registered for less than a full calendar year, then the excise is going to be based on it's going to be a portion based on the number of months. It doesn't get apportioned right to the day. It just gets apportioned to the month. So if you own a vehicle, if you have a vehicle registered 1 day in a month, you're billed for the entire month. If you purchase a vehicle in the middle of the year, your original excise tax bill that you get from the registry should be apportioned based on when you registered the vehicle. If you sell a vehicle or you trade in a vehicle after paying the excise tax, you'll have to apply for an abatement to get the refund back. So if you, for example, purchase a new vehicle and trade in an old vehicle in the month of, say, May, you would have already gotten an excise tax bill for the old vehicle. Presumably, you would have paid it because you would have paid it. You would have gotten the bill sometime in February, probably paid it sometime in March, and then in May you buy a new vehicle. So you're going to get a new excise tax bill for the new vehicle that's going to be apportioned for the month of May through December. So you're going to get it for 8 months out of the year based on the value of that new vehicle. You already paid for the entire calendar year on the old vehicles, traded it in, then you'll want to make sure you get the taxpayer will want to make sure they get a copy of the receipt of turning in the plates, or if it was the plates were transferred to the new car, then just a copy of the registration showing the transfer of the plates to the new car should do it. File an abatement application, and they should then be getting a refund, a portioned refund for the 8 months that they paid on the old car. The minimum motor vehicle excise is $5. If the calculated excise is less than $5, then the tax is $5. So for example, if a car comes in at, if you do the math, and 2.5% of the value comes to $3, they get a bill for $5. So $5 is the minimum, no matter what. Going on to the next slide, talks about the value. So again, we talked about what the value is, and that is, in the realm of real estate taxes, what is the value of a home? That's part science, and the assessors determine that. But with regard to motor vehicle excise taxes, the law is very, very clear. As Jim alluded to in his presentation, it is the manufacturer's suggested retail price at the time the car was new. So the vehicle's value is not, you don't go on Kelley Blue Book and find the value of the vehicle. You don't go on the NADA website or JD Power or anything else to find the value for purposes of the excise tax. You have to get the MSRP, manufacturer suggested retail price, and it's of the base model, so they don't take into account any add-ins. So it's the manufacturer suggested retail price when the car was new. And then that value is then depreciated based on the schedule. So if you have, for example, a 22. So if you have a 2022 Honda, In 2021, if it's on the road and registered, you're going to get the value for purposes of calculating the tax is going to be 50% of that MSRP. In the year 2022, for a 2022 vehicle, it's going to be 90%. And then it goes down progressively every year until you get to the fifth year. So it goes down to 60% of the value in the second year, 40% in the third year, 25% in the fourth year. And from the fifth year moving on, it is 10% of the value of that vehicle. So then you can see my little question. I have a picture of a 1927 Ford Model T. What is my taxable value? So keeping in mind, so, you know, I pulled up the Kelly Blue Book and I pulled up J.D. Power. And you can see here what the prices are for, what the values are today for 1927 Ford Model T antique vehicle that is completely refurbished. So if you want to throw in the chat, what do you think the value is for purposes of calculating the excise tax? Feel free to type that in the chat. I'll give you a few minutes. I see everybody's typing in 485, which is the correct answer. So $485, even though, you know, today, a 1927 Ford Model T, 1927 was the year I picked just because that's the last year that Ford ran the Model T. And the highest sale value for an antique refurbished Ford Model T, you can see, was $145,600. Notwithstanding that, Massachusetts law says it's the original MSRP when it was. So now, if you calculate an excise tax based on that, if you want to do the math, what would the excise tax on a $485 value? If you want to throw the answer into the chat, then that'll be the quiz. I don't have a quiz. So we know it's 2.5% of the depreciated value of the original MSRP. So it should be $485 times 10%. You get 2.5% of that. And I see people are coming to $5, which is the correct answer. So just to run through the math, I like this example because it brings up a few points. It makes the point, I think it brings home the point that it's the original MSRP when the car was new. So there's no looking up Kelly Blue Book to find the value. There's no, you know, my car was in an accident or, you know, this, that, and the other thing. It's strictly, the law says it's original manufacturer suggested retail price when the car was new, and then depreciated by that schedule. So in this case, the original MSRP was $485. 485 times 10% is $48.50. So the taxable value for purposes of the excise tax for a 1927 Ford Model T in the year 2022 would be $48.50. Multiply that by the excise tax rate, which is 2.5%, and you get $1.21. Because that's less than $5, the minimum excise tax applies, so they get a bill for $5. So that's how the excise tax is calculated. That math is actually done by the Registry of Motor Vehicles. When they send the data file, it comes through with all this data, and the calculated excise tax is one of the fields. So there isn't a lot that needs to go into sort of analyzing excise taxes. It's pretty much, we receive a data file, it's downloaded into our billing system, the bills are sent out, and everything should calculate correctly. There have been occasions in the past where the Registry of Motor Vehicles may have made a mistake, putting in the wrong MSRP on a model, and then things have to be corrected. If something like that happens, it's going to happen across the entire state. And it would happen, I think this was the model, I don't remember what it was a few years ago. There was a model car, I want to say about 10 years ago, that the registry had the wrong MSRP, and everybody had to be adjusted statewide. Some notice that went out to everybody. So this is one of those things that's either going to affect everybody or it's going to affect nobody. So just to keep that in mind as far as how the tax is collected. As far as collecting the excise tax is concerned, when we receive the data file from the Registry of Motor Vehicles, it is up to the assessors and or the collector to determine when the bills are mailed. They determine that based on their work plan for February or March or whenever they want to mail the bills. But the tax bill is due 30 days from the day it's mailed. So there's going to be, collector needs to sign an affidavit of the mailing of the bills and have whatever evidence we need to back up the day the bills were mailed. And the due date on the bill, or the due date of the tax, is 30 days from the date it was issued or mailed. And the tax collector's office must receive the payment. The date the payment is received is the operative date. So it is, if it is received on the 33rd day after the tax bills were mailed, then it's late. If it's received on its 29th day or the 30th day, then it's on time. So it's when it's received, not the postmark, not when the taxpayer put it in the mailbox. They could put it in the mailbox and have it postmarked by the 30th day. But if it's received in the collector's office, then it is late if it's received. Put it in the mail on the due date, you're pretty much guaranteed it's going to be. There is no statute of limitations for motor vehicle excise tax bills, as Jim mentioned earlier in the presentation. Taxpayers are personally liable for the excise tax until it is paid off. Just to give you a little bit of a war story, I recently had somebody in the office who moved in town when she was in college in 1984, moved to Illinois, and the month or two that she was in Newton, registered a car in Newton and got an excise tax bill, then moved to Illinois, never paid it, lived the rest of her life in Illinois, and just recently decided to move back to Massachusetts. And when she went to go get her license and registration transferred to Massachusetts, surprise, the 1984 excise tax bill. We had to do some research and find out what the deal was with that excise tax bill, and she had to pay that excise tax bill plus the appropriate fees that were applied at the time. And then we were able to dig out of our vault the old forms. Some of you may have seen the old forms pre-1993, 94, somewhere around the time when the marking started. We used to suspend people's licenses and registrations. That isn't done anymore. Now we just do the marking, but people that got suspended, we have to still send those old forms. We got to go find those forms and send them in. So it is something that happens rarely, but it does occasionally happen, that somebody has to pay a tax that is extremely old. And universally, they will all think we're crazy, but it is what it is. There's no statute of limitations on motor vehicle excise tax. But as Jim mentioned, there might be some time limits on the ways tax collectors can enforce the excise tax. So there are things that we can do that we can't do after a certain amount of time. For example, a notice of non-renewal. So if we need to mark a vehicle at the Registry of Motor Vehicles, it has to be submitted to the RMV within 2 years of the mailing of the original tax bill. So if we issue tax bills next month in February of 2022, we have until February of 2024 to mark that vehicle. And the registry will actually reject the mark if we don't mark it within the appropriate time frame. So we have 2 years to get it marked. So we have to make sure we go through all the steps. I'll talk about the steps. Another issue that comes up is another way that we could collect is we can file suit against the taxpayer. We are allowed to file an action of contract. Not mentioned here, I'll just mention it verbally. We can file an action of contract in the small claims court or in, if it's large enough, in district court. And that has a 6-year statute of limitations on filing that type of action. So again, there are time limits on the actions we can take, But once it is marked at the registry, if it is marked within that 2 years, it stays there forever. The registry did have a recent change in its software, Atlas system. And my understanding, and if somebody knows more about this, feel free to put it in the chat. My understanding is that they only transferred over marks that go back a certain period of time. I'm forgetting how many years. But if somebody knows the answer to that question, you can pop it in the chat. So there might be a point in time when the marks that are really old just aren't effectual anymore, just because of their changing system. So another question that comes up often is partial payment. So if somebody owes a tax, an excise tax bill, can they pay half of it now and pay the rest later? Can we give them a payment plan? Can we do different payment terms with different people? We can't change the due date. If we issue the tax bills on a certain date, the tax is by law due 30 days later, and the interest at a rate of 12% starts accumulating the day after that due date. A tax collector does not have to accept partial payments of motor vehicle excise. Accepting partial payments is solely at the collector's discretion. So we can't change the due date. We can waive fees as long as they're $15 or less. As soon as you hit $15, we can't waive fees and interest. We can accept partial payments, but it's at the collector's discretion. Collectors could make the decision that the entire bill is due in 30 days, so it's unreasonable to do a payment plan that is that has to be paid in full within 30 days, or to encourage late payment, anything along those lines. So it's solely at the collector's discretion. If the collector accepts partial payment for a particular motor vehicle, the taxpayer still cannot direct that it goes to the tax first. It goes first to interest, then it goes to collection costs, then it goes to the tax. If there's a over from the partial payment, if the collector accepts partial payments. If the collector waives interest and costs because they total 15 or less, then obviously no payment would be applied to the waived interest fees. It would be applied to the so as I mentioned earlier, there are some penalties. When a taxpayer fails to pay a motor vehicle excise, the tax collector can collect the excise by marking the motor vehicle, and that marks their registration, and it also marks their driver's license. So when they try to re-register another vehicle, no, actually that's not true. They try to re-register their vehicle or their driver's license, it's going to stop them. My experience is that it doesn't stop them from registering a new vehicle. So if somebody is marked with the current registration, and then if they junk their car or they turn it in and they get new plates on a new vehicle, the system, my experience has been that the system doesn't stop the new vehicle from being registered. It only marks the vehicle that the tax was on. But then when they try to get their license renewed, they'll have a problem at that time. So collector can also bring a lawsuit. Again, that's within 6 years of the date the excise is due and payable. We can also withhold any payment from any amount that the city or town pays to the taxpayer. So for example, if somebody's getting a refund on their real estate taxes and they owe money on excise taxes, then we can use the refund to pay off the excise tax. I have a form letter that I set up that's basically called it's a very friendly sounding letter that says, I am pleased to notify you that your refund has taken care of your excise tax bill. So you no longer have to worry about that, and enclosed is a check for the difference. So we can do that. I would be wary of, however, of city or town employees payroll checks. If you try to withhold somebody's, if you try to use the set-off statute against a city or town employee who happens to also have an excise tax bill, you're going to run up against in the wages statute. You're going to run up against a lot of other issues. You could run up against a union contract. So I would, if you're looking at doing a set-off against an employee who owes money on their excise tax bill, I would make sure you get the advice of legal counsel before going ahead and taking that action. You could end up finding yourself in violation of some other thing. So I'm not saying it can't be done, but it is something that you definitely want to make sure you do in a very thoughtful manner. You can also, if the community has adopted Chapter 40, Section 57, which allows the denial or suspension of local licenses and permits, this certainly applies to that. So you have a excise tax bill that is owed by, for example, an auto dealership in town, then you can have their auto dealer license denied or their renewal suspended or anything along those lines if they didn't pay their excise tax bills. So just some things to keep in mind that go beyond just marketing, because a lot of times we're relying on the mark, but we have some other tools as well that complement the marketing of licenses and registrations. So fees and interest, again, the taxpayer has to pay in full within 30 days of the bill being mailed. It says receiving the bill. I got that language from the state. It actually is the date the bill was mailed. They have 30 days from the date the bill was mailed, not the day they received it. That's a misprint. If they do not fully pay it on or before its due date, then interest at a rate of 12% per year starts accruing the day after. And then if we issue a demand notice, the demand for the payment of the excise is set locally, up to $30. Historically, it was $5. And there was a change in the law a few years back that allows that to be set locally in an amount up to $30. Just keep in mind that if you're under 15, you have the flexibility of working with the taxpayer and waiving it. But if the demand fee is 15 or above, or even call it 14 and above, the fee plus interest, you're going to lose the ability to work with taxpayers because, and that may be something you prefer, but you lose the ability to work with taxpayers because once you hit that $15 threshold, you can't waive the fees anymore. Beyond that, if they don't pay within 14 days of issuing the demand, then the collector can issue a warrant to a deputy collector. And then also the deputy collector would send a notice to the taxpayer. So there's two transactions combined almost in one. There's transferring the bill over to the deputy collector, and then the deputy collector sending a notice. The transferring it to the deputy collector is a $10 fee, and then the deputy collector sending out a notice is a $12 fee. So that adds, and those are flat fees. Even if the tax itself is only $5, at this point, you potentially could have $30 demand fee added onto that $5 bill, another $10 fee, another $12 fee. So the fees and the interest really do increase the amount owed by the taxpayer substantially. And then after the notice is sent by mail, the deputy collector then, as Jim alluded to in his presentation, has to serve the final excise warrant on the taxpayer at their address in person or at their last unknown place of residence or place of business. And then after the final warrant is served on the taxpayer, then if that's not paid within the appropriate time frame, then the vehicle is then marked to the registry. And when a vehicle is marked, that adds another $20 fee onto the bill. And that $20 fee is actually ultimately ends up going to the Commonwealth, because you may have noticed when we get our local aid, one of the state charges that we get charged is RMV fees. Ultimately, we're kind of a pass through. It's through the local aid process, but we collect the $20 and the state ultimately ends up charging the city and town through the local aid process. So just to sort of summarize the collection process, first the collector sends a demand for payment after the bill is issued and the bill has become due and payment was not made. We have to wait at least 2 days after the due date. Can't send the demand notice the day after. We have to wait until 2 days have passed. Then we can send the demand. So we send the demand notice out, and the taxpayer now has another 14 days to pay the bill with the demand fee and the interest included. If they don't pay it within 14 days, then after the 14th day, the collector can issue the warrant to the deputy collector. And when they transfer the bill to the deputy collector. And then once the bill is transferred to the deputy collector, then the deputy collector takes over collection of the bill, and they will send out the next notice to the taxpayer, notifying the taxpayer that it's been transferred over to them. And then finally, the officer, the deputy collector, has to wait at least 30 days after the warrant, the initial warrant, mailing warrant, to do the service of warrant. And then they're supposed to be 30 days. And then they can, after they've served the warrant, then they can, if the taxpayer still fails to pay the excise tax, then they can mark the license and registration of the taxpayer at the registry of motor vehicle. And then the mark stays on the taxpayer's registration and license until it is paid or abated in full. And that is my presentation. If there are any questions, I haven't seen any questions in the chat, but if there are any questions, please feel free to type them in at this point, or I'd also give another plug to the Department of Local Service, Division of Local Services YouTube videos. They have actually a lot of YouTube videos on a lot of different topics. So if you go to their YouTube page, they have a whole YouTube channel. They're really with it in terms of putting videos out on YouTube. And they do have a whole bunch of videos on excise. There's one on assessments. There's one on exemptions and abatements. And they have a lot of different videos on real estate taxes and other topics as well. So I would encourage you to take a look at those videos as well. They are very informative. So that is what I have. If there are no questions, how long do you have to issue a demand? So I saw a question come through. So you have to wait, as the question says, you have to wait at least 2 days after you send the excise tax. There isn't a time limit on issuing a demand. It delays any further collection process. The collector can issue the demand whenever the collector determines that it's time. Now, interest, 12%, begins accruing the day after the bill is due. The demand fee can't be added to the balance due until the demands are mailed, but the collector determines when the demands go out into the mail. Once the demands are mailed, then the demand fee gets added to the balance due. And then similarly, after the 14 days is up, interest continues to accrue, but the collector again makes the determination as to when the bill is then referred over to the deputy collector for further collection. Any other questions, feel free to put them in the chat. Otherwise, I will be more than happy to turn things back over. I don't know if Beth, you have any last remarks that you want to jump in on, or if you want to release everybody for lunch.
Ron, I just want to thank you so much for such a great presentation. This has been very informative for me. I feel now I can be a collector, because a lot of times if you don't pay your dues, I learned a lot about collection here today. So I don't want to interrupt anyone's lunch, so I'm going to stop the recording and I'm going to let you have a nice lunch. And we're going to start off with
There is a message in the chat.
okay.
Is it
Didn't
the
he
how
just do
long?
that?
If it's the how long to issue a demand, that's the only one I see. That one I just answered.
Okay, sorry.
We're
That's
back in 12:45. You can always turn off your video instead of logging back off and on if it's easier.
If you've been up to,
Sorry.
just a second there, gotta make it happy. And so if you've come up to school, you may have come through Shutesbury. I have been collector in Shutesbury for 46 years. And but I've also been collector in several other towns as well as treasurer. I am technically retired. I work 15 hours a week for Shutesbury every morning. So let's begin. First of all, those of you who are in an office with a collector or a collector treasurer probably know that your collector is either a town collector or a tax collector. And you may wonder what the difference is. Well, very simply put, if it's a tax collector, then all it can collect is taxes. So that's all your office collects. If it's a city or town collector, you can collect other things like water and sewer, trash fees, utilities, inspectional services. I had to become a town collector to handle ambulance payments way, way, way back. So there's all kinds of other things that get involved if you are a town collector. And you all know probably basically what the duties of the collector are. First of all, when you become a collector, you have to take an oath of office, usually administered by the town clerk. Now, you can't or are not supposed to do anything towards billing until you receive a warrant from the assessor. Now, one of the things you're going to find is the term warrant is used in several different ways in our profession, and it gets very complicated. So let's start with the following. The warrant says that you, and it has your name on it if you're the collector, must collect the taxes committed to you. And what it doesn't say, though, and the law says, is that you have to turn your money over to the treasurer at least once a week. That's your collections. And with that, you have to give him or her an account of where the money is to be applied. In other words, is it to be applied to 2022 real estate, 2021 excise, water, sewer, whatever. And should the assessor's request, you have to give a report in writing of your actions pertaining to that warrant, containing such information as, well, it was billed on this day. Here is a list of what has happened in the interim, and here's the balance outstanding. In my years, I have never had a board of assessors ask for this, thank goodness. Another thing a collector must have, and you must do it yearly, is apply for a fidelity bond. And the fidelity bond is covering the outstanding taxes committed. The state sets the amount, the minimum amount of the fidelity bond, except we have learned that sometimes it's a good idea to talk to your auditors, find out what they suggest your amount would be. As a matter of fact, at one point the town was written up because they found our bonds were too little by going by the state. Now it has come to pass that we have to do this yearly. Now, if you're not a collector or an assistant collector who has to be bonded, that doesn't mean you who handle money don't have to be bonded. Most towns have a bond over all staff that have to be, that handle money to cover them in case of default or what have you. Some of you deal with an assistant collector. The assistant collector will have been appointed by the mayor, if you're a city, or the select board, if you're not. And the assistant collector can do everything the collector can do, with one large exception. They cannot sign instruments of taking, which is part of the tax title procedure. Other than that, they can do everything that the regular collector can do. So let's start. You are in your office, and what if you work for a collector, what do? Of course, you collect money, you collect taxes. Technically, you're not supposed to be able to collect them until the commitment and a warrant are received from the assessors. And the assessors prepare a commitment list. Now, sometimes it's not the assessors. For example, I just got a very large, my first 2022 commitment 1 on motor vehicle. That was actually done by my company that handles my accounting software. And they sent it to me. So it's a commitment list that I then give to the assessors. And the warrant telling me how much I have to collect. Now, this is done not only for excise, and it's done individually for real estate, personal property, betterments and liens, community preservation, or Cape Cod Land Bank, if you have it. And in my case, I have Title V. What Title V is, it's people who borrowed from the town on a state program to have their septic systems redone. Many of them have a 20-year loan with the town, and it is collected through their taxes. It ups their real estate taxes. So I have to receive a separate amount for that, both the principal and the interest. That's on one warrant. So these are the kind of thing of warrants you get. The real estate commitment is a list of parcels. It has the name of the assessed, perhaps an in care of for a second line. We use the in care of if the property's been sold to get the correct address and name of the current owner. Sometimes it's done because there are more than one owners on the deed. The mailing address. Now be very careful on that, because sometimes your mailing address is not your street address. We have a number of streets that get mail delivery from another town. So you have to make sure you have the mailing address correct. Has to have the property description. Usually that includes what the coding is, the map and lot that the assessors use to designate the parcel. Has the acreage or square footage and the location, what street it's on. It has the valuation, the tax amount, and normally it has a tax amount for each of the quarters or the semi-annual, the two for the semi-annual that you have, that you are billing. Has betterments and liens, and sometimes you have district taxes. Now, should you lose a warrant, and that sometimes happens, you can get it replaced by the assessors in the same amount that the original warrant was. If you become a collector and there are outstanding bills of warrants, you should receive a warrant from the assessors just for the amount that is still outstanding. When you receive your warrant, check it to make sure that the totals of the tax bills agree with the commitment, because that commitment is the amount that you or your office have to collect or have abated. Now, the commitment book is a permanent record. Now, that's a little hard to do when you're doing it on a computer, and most of us are. So I'll tell you what I do is I put them in ring binders, and then when my commitment is totally satisfied, I have no balance left, and I've had an audit of the year in which it became nothing left, I then have it bound. Well, you're saying, where do I get it bound? Well, you can get it bound at almost any stationery store. You can get it at Staples, for example, or anything like any company like that. If you are anywhere near a college where they do having to do dissertations and such, you can probably get it at copy centers. I'll tell you, mine cost me right around $80 a book to have mine bound. And I have a special line in my budget for binding them, because once again, it's permanent. So in order to keep it in a form that is not destroyed or lost, you really should have it bound. Now, the disposition of every tax, whether reassessed, abated, or paid, must be accurately entered. You can also sometimes receive payments early. For example, people may want to pay their real estate tax before it's due because they want to take a tax deduction. That's not as prominent now with the change in the tax law as it was a few years ago. But then you can accept it, even without the warrant, with a special warrant from the assessors. Now, let's talk about preparing and mailing tax bills. The collector's office is responsible for mailing the tax bills. The tax bill has to be in a manner, it says approved by the Department Commissioner of Revenue. Well, that's what the law says, but now there's an IGR guideline that tells you if you have a system from any of the major vendors, they know all this and they create the tax bill in such a way that it meets the requirements of the state. What does a tax bill have to have? Well, it has to have the assessment date and the fiscal year. Has to have taxpayer information. Once again, the property identification and location and description. Valuation information. Special assessment information. Payment information, in other words, when the payments are due. Payment instructions such as where do you send it to, the collector's office hours, and it has to have information, usually on the back, about the right to appeal the bill with the assessors. That's nothing you do. The act under the law, and this is something that came into effect probably 10 years ago, actual real estate tax bills must have a statement of overdue municipal taxes and charges. Now, that doesn't mean they have to be exact and show a monetary amount. It may include a statement that says simply there's a delinquency. I use stamps and actually stamp the bill with such things as this property is on tax title. Contact the treasurer. Or the bill has a balance outstanding for 90 days for last year. Contact the collector. And frankly, it was done with the idea that the banks would then know that there's a problem, but I haven't found that to be the case. And there are some examples on the sheet of exactly what the stamp could look like or what you could have printed on it. Yes, it takes a little bit of time, but it's necessary to comply with the law. Another kind of billing for real estate you may end up doing is what's called a supplemental. Unless your town voted not to do a supplemental tax bill, and you have some building going on that would result in the value of a parcel increasing more than 50% during the year, and an occupancy permit having been issued after January 1st of the year in which the fiscal year began, then the assessors must commit to you a supplemental tax bill. Now, one of the problems you can get into is when you mail your tax bills and documenting it. And this is not only for real estate and personal, but also for motor vehicle. There is a form called the Affidavit of First Mailing that you can fill out, have notarized, and then turn it over to the town clerk, and you keep a copy. I also give an original to the assessors. And the reason for that is that the assessors may well need this document in order to prove, if they're taken to appellate tax board, when the taxes were mailed. So I give them an original, and then if it happens later on, I don't have to worry. They've got the information in their file. Now let's look at due dates. First of all, there are two different kinds of payments schedules on the real estate. We have what are called semi-annual. They are paid twice a year and billed twice a year. Then we have quarterly. The quarterly taxes are billed 4 times a year, but could be mailed only twice. For the semi-annual, the interest on the semi-annual, if 1/2 of the tax remains unpaid after November 1st of the fiscal year to which the tax relates, interest will accrue at the 14% per annum from November 2nd if the bill was mailed out on or before October 1st. If it wasn't and it's sent later, then it's 30 days from the mailing date. So on the 31st day, interest accrues. I know from experience, having had towns on semi-annual, because the quarterly is a relatively new creation, probably 30 years ago, 25, 30 years ago. You very seldom were lucky enough to get your bill out by October 1st. But then again, you just count the 30 days afterwards, and that's when your interest starts to accrue, the day afterwards. On your quarterly, your first 2 quarters of your quarterly are called preliminary. They are based entirely on the values of last year's taxes, except that you can up them under the law 2.5% if your town so desires. We do not do that. They are due in 2 quarters, August 1st and November 1st. Note the November 1st again, as was in the semi-annual. Now, preliminary bills should be mailed by July 1st. Legislation, however, now allows them to be billed by August 1st. If you want to bill after July 1st, then you must obtain permission from the Commissioner of Revenue. If the bills are issued on or after August 1st, once again, you have the 30 days after the date of mailing. And the second bill would be due on November 1st, or 30 days after, or 30 days after the date of mailing, if mailed after October 2nd. The actual tax bills represent the next 2 quarters. They are February 1st and May 1. You credit the preliminary payments to the accounts, and then the next 2 represent what I call the difference. It's the makeup to enable the person to have paid the full amount based on the current value and the current tax rate. The first is due February 1, the second May 1. However, there is a problem. If you mail the bill after December 31st, the entire balance, both the 3rd quarter and the 4th quarter, is not due until May 1, or 30 days after the bills were mailed, whichever is later. One of our colleagues a few years ago got into a problem. They had an outside service doing their mailing. They got the information, they got the bills to the company. And for whatever reason, the company was delayed in doing it. They said they mailed it on December 31st, but in fact, they didn't mail it until the beginning of January. Hence, all of their bills became due on May 1. That is a very, very, very nasty situation. It costs the town money because then technically nobody has to pay their bill any earlier than May 1, which results in a problem with cash flow. Interest on the quarterly system, once again, is the 14%. And it's on basically August 2nd, November 2nd, February 2nd, and May 2nd. And we calculated from there. The exceptions are if any payment date falls on a Saturday or a Sunday or a holiday, or if the municipal office is closed as authorized by your town or city charter, bylaw, ordinance, or otherwise for a weather-related or public safety emergency, then the payment may be made without interest on the next day on which your office is open. Now, it doesn't mean that, oh, well, everybody they decides to take the day off or something, because if there's no provision, it's not a weather emergency, it's not a COVID emergency, it has to be something that is specific, a specific type of emergency in order for this to be delayed even further. And most of us probably have boxes outside the building where people can put the money and put the payment. So therefore, there really is no reason for them to have to come into the building at all to pay you. Many of us put stuffers in with our real estate. I put a stuffer in explaining how to do my online banking and my online payments. Another thing I use sometimes, well, when I'm doing a demand, I have a little piece of paper that says that you have 14 days to pay this bill and citing the law. Another thing I use stuffers for, there was a time recently where the calculation of the motor vehicle excise changed because they had to start evaluating vehicles at full amount, not rounding off as they were doing in the past. So I put a stuffer in with my envelopes to explain why people's values had changed. Because if the people had excise taxes for more than 5 years, they were expecting the same tax bill, and it wasn't. So I gave them a little stuffer. But they must be non-political, must be municipal informational material, and they can't result in increased postage. And that is even if the person who wants it put in volunteers to pay the bill. You cannot do it. Now, you've gotten this warrant, you've sent out your bills. How are you going to be able to get that commitment down to zero? Well, let's talk about that for a minute. First of all, you get cash or checks from taxpayers, mortgage companies, etc. Daily, the collector or the collector's office has to enter the amount paid into the cash book, specifying the total amount of each kind of tax. And when you get abatements, etc., from the assessors, you have to enter them. You have to enter all interest charged and the date of receipt. Now, most of us, since we have computer systems, by entering them into the cash book and or the commitment book, whichever you want to call it, it enters them into both. Excuse me, if you're from a small enough town where you still do things manually, that would require you to post it twice, once to the commitment book and once to the cash book. That's the way it was when I started. You turn over the receipts to the treasurer, once again, at least once a week. That's law. And a summary of all of the kinds of taxes, etc., must be prepared when you turn over the money. And it should be done at least in 3 copies. 1 copy goes to the accountant. 1 copy goes to the treasurer with the cash, or if you're turning cash over, or some kind of document to show basically that it was transferred by the bank. And then one you keep. And you can do this via computer. I actually do a 4th one. And the reason I do a 4th one is I use the 4th one to put all of the receipted bills together for the week, put them together with an elastic band and put them away, because I know the auditors are going to want them when they come to visit. As a collector, you can accept partial payments. The law states that you can only receive partial payments of at least 10% of the tax bill, or the amount of $10, whichever is greater. Now, the collector can determine how payment is posted unless it's directed by the taxpayer. However, no matter what the taxpayer says, interest and penalties are paid first before the taxes. That's very, very important. Let's talk about abatements for a minute. Abatements come to you from the assessors. An abatement is a reduction in value, which results in a reduced tax bill. And it will also, or if there is a community preservation or land trust account associated with that real estate, then it will also affect that amount, and that will be reduced too. You also get exemptions information from the assessors. And an exemption is a special relief granted by assessors to taxpayers who meet certain qualifications, such as certain types of veterans, the elderly, the blind, widows, widowers, etc. These are people who perhaps usually are low, except for veterans, are low income. And that's one of the other pieces that has to be involved in it. Abatements create a reduction in the CPA taxes. Exemptions for all but veterans may result in a reduction of the CPA. Our assessors do a whole separate exemption of CPA and a 100% exemption. They don't make it, reduce it by a little. They do 100% exemption. And veterans would only receive it applied to the CPA if they receive a 100% abatement. You receive the abatement certificate from the assessors and you post it. I suggest you post it as soon as possible. You also post it to the spreadsheet that you are keeping that shows your current value of your account, how much you still have outstanding. I do it as an Excel spreadsheet for each different kind of tax and each year of the tax. And what I do is I simply use the following formula. Commitment, less payments, less collections, less abatements and exemptions, plus refunds, which we'll talk about in a minute, less tax title will equal the balance currently outstanding. Another thing with your abatements is you should tally them every month and make sure it agrees with the form the assessors give you, which is a monthly document of all the abatements they've granted. They do it for the accountant, and they should give you a copy. And it's a quick way to make sure that your information is correct. Sometimes you get a situation where a taxpayer has already paid, let's say 3/4 of the bill, and they get $1,000 exemption. And if their bill is only $900, that would take care of the fourth quarter, and it would take care of $100 of the third quarter. But they've already paid it. So that results in an overpayment, which would result in them receiving a refund. I urge you to do the refunds promptly. Don't let them sit until the end of the year. That's not good policy. The taxpayer is entitled to interest also at 8% from the time of payment or the final tax due date of the fiscal year, whichever is later. However, unless the taxpayer asks for it, we usually, frankly, don't do it. There is one other type of tax reduction that a taxpayer can take advantage of, and it is called a deferral. Next page, please. Oh, there, you're on it. Okay. Persons age 65 or older who had meet certain ownership qualifications may apply for a deferral, and it's up to the assessors to determine the eligibility. A person who enters a tax deferral agreement may also defer water, sewer, and betterment assessments and liens because they are added to the tax bill, but not the CPA. Eligible taxpayers may defer the real estate taxes and all these other taxes up to 50% of the assessed value of the property. And the assessors are responsible for keeping tally of how much is being deferred. The collector receives a listed deferral from the assessors and posts it to the proper accounts. The collector certifies the accounts and amounts to the treasurer and the accountant. And I would suggest you talk to the accountant to find out what terminology they would like used when you do this turnover. The following years are handled just like subsequent tax titles. Interest on the deferral can be a maximum of 8% from the due date of each bill. But your legislative body of the community, which can be your town meeting or your select board or your council or whatever, can determine a lesser amount, and frankly, usually do. And the lower tax rate occurs until the property is sold or until the taxpayer passes away. Then the interest goes back to 16%. Any change in the rate must be voted no later than July 1st of the year to which the tax relates. And the new rate would apply to fiscal years beginning on any July 1st after the vote. So if you do it at town meeting this year and your town meeting is in May, it would take effect this July. You also can have Chapter 59, Section 5, Clause 18A, which is caused a hardship abatement. Taxpayers don't have an age requirement on hardship, and the financial hardships can be due for any one of a number of different situations, including a change to active military service. And the assessors have the right to determine what those qualifications are. The property must be owned by the person as a domicile or jointly owned for at least 10 years. And a deferral can be given deferral can be given for no more than 3 consecutive years. At the end of the period, the deferred taxes must be paid in annual installments through a 5-year window. The first payment is due 2 years after the last year of the deferral. And it operates the same way as a deferral available to qualifying seniors. Now you've gotten the bills out and the May payment is due. Excuse me. And you have some people who haven't paid the May payment. So what's the next step in the process? As soon as 1 day after the due date, which is called the grace date, believe it or not, you can issue a demand on all bills that have taxes outstanding. I urge you to do it to everyone, treat everyone the same way. This demand is due in 14 days. As I mentioned, I put a stuffer in telling people that this is especially relevant for motor vehicle. In reality, although the real estate and personal are due in 14 days, I usually give them a month. And the fee for the demand depends on what your town has voted. Way back when, it was $5. Then it became anything up to $30. So some of you have 30, I still have 5. Why? Because if I ever dare take it to town meeting, because of the wording of the law, I wouldn't be half surprised to see them decide to take it to 0. So as a result, I just keep it at $5. And the interest is 14% on real estate and 12% on motor vehicle. So now you've got the demand out there and you waited the whatever time you feel appropriate, at least the 14 days. Then the collector can issue a warrant. Once again, another term of warrant, except this warrant is a warrant for collection. Usually it goes to your deputy collector. And the decision to issue the warrant is totally up to the collector. I do warrants on personal property because that's the only thing I can do aside from taking people to court or hiring an outside company. But when you only have 2 or 3 bills outstanding and they're fairly small, then it's probably a good idea for me not to hire an outside firm and just put them on warrant. For real estate, however, the best way to collect the money is to go what's called tax title taking. And that is kind of a hard term to explain because we call it tax title, but it really isn't. What you are doing in essence is to put a lien on the property in such a way that the person cannot sell it or should not be able to sell it unless the lien is taken off by payment. It is by far the best way. It takes a few steps, but it is necessary and it should be done in a timely manner. The reason for that is a transfer of title can make it impossible to do a tax taking or tax title. If the transfer of title, if you are more than 3.5 years from the end of the fiscal year for which the taxes were assessed. So this December 1st, for example, December 1st of 21, anything that was assessed, well, let's see, December, okay. 22, 21, 20, 19. So anything that would have been fiscal 19, no, 18. Anything that was fiscal 18 and before cannot be done through tax title. That's why it's important that you do them promptly. I do them every year. Okay. The tax title, we say, perfects or ties the lien to the parcel in the event of a change of ownership until the taxes are paid or the parcel is foreclosed in land court to the community. Failure to do this may lead to trying to get the taxes from a previous owner, which in civil court, which only gives you an extra year, and that would be next to sometimes impossible. And you don't necessarily get told when people are selling the parcels. I had a situation when I first started where I had a lawyer from for another state. It was a whole transaction done with people from another state. They didn't know mass law. They never did a tax search, a lien search. And when I found out that this occurred, I managed to track down the lawyer, informed him, I'm sorry, sir, there is an outstanding tax bill for the previous year on this bill. And he ended up writing a check personally to cover it because he knew he had blown it by not even contacting my office to find out what was wrong or whether there was a payment or whether there was anything outstanding. Where you're dealing with a lot of banks that are outside and a lot of new owners that are outside the state, it's always a good idea to check the registry of deeds for any sales or get that kind of a list from the assessors every month, and be sure that you find a way to contact the banks to let them know there's an outstanding. Before I go to tax title, I always take a look and see if there's a mortgage on the property. And if so, I contact the bank and say, yoo-hoo people, I'm about to take a tax lien on it. And most of the time, the banks will pay it because they don't want me involved because my lien supersedes their lien. Okay. So here is some of the requirements before you take or start the procedure for a tax title. A demand will have to be issued more than 14 days before the posting and publication of the notice of taking. You have to advertise it in a local paper at least 14 days before the taking. I suggest you do it more than that in case there's an error in the ad. I had a situation several years ago where the information I gave the bank, the newspaper was totally correct. And what happened was somehow the newspaper blew it. And I was doing it on a Friday. I was closing it on a Tuesday. So I was giving about 17 days. And it's a good thing because they had to put it back in the paper that next Monday. So I always give myself a few more days. Also, at least 14 days before the taking, you have to post the notice of tax taking 2 or more convenient and public places. I post mine outside the town hall, and I posted it at the post office. Now, during the 14-day period between the time you actually do the posting and the advertising and the date that you're going to file your documentation with the registry, you should not accept proper payments, partial payments. You cannot do that. And if they're going to pay in full, I suggest you use cash or a certified check or a bank check just to make sure things don't bounce and they're not trying to delay your process. At the designated time and place, which is indicated on the ad, the collector announces that he or she is taking the property for the city or town. And then the collector prepares what's called the instrument of taking. This is a document that can only be signed by collectors. And then it has to be recorded within 60 days at the registry of deeds. I do it immediately because that way I can then turn it over to the treasurer to set up as a tax title account, and then he can go after the delinquent. Another thing, before I go through and do the tax taking. I send out another letter. It's a letter that is actually part of my software, but it's something that's existed for several years, as a suggested document. And it starts something to the effect, I have been, asked by the town of Shutesbury to collect all real estate tax bills. And you have one that's still outstanding and you have 30 days more to pay it. And then it's going on tax lien. And it usually works. It brings in a lot of the parcels. It gives them an extra year to pay, an extra month to pay. And at the same time, it is kind of like a yoo-hoo. Let's, you still have an outstanding situation. It also asks them if they need to contact me, and we'll arrange payment. So it's one more step. It's optional, doesn't have to be done, but at the best of my knowledge, most of the towns do it because it is also a little bit more friendly than just going into the tax taking. Once you have property on tax title, Chapter 375 of the Acts of 1995 allows collectors and treasurers to make bulk assignments of uncollected real and personal property tax bills and other receivables secured by municipal tax liens. I do not do this because I don't have that many taxes bills outstanding or that many in tax title. However, if you do, it is a way of thinking about doing things, and I suggest you research it. Now, what happens if you have a property on tax title and the next year they still don't pay? So they haven't paid this line and next year they don't pay. Well, then you turn it over to the treasurer as what's called a subsequent tax title. And he just adds it to he or she adds it to the amount of the tax title. And please do it before July 1st. That way it is out of your account and does not reflect on your balance outstanding as of the start of the new fiscal year. And it's really easy to do. It's just one form to fill out, list all of them, and you can then just give it to them and they sign one sheet and give it back to you. And you have it as of July 1 taken care of. On personal property, you can't do tax title. And you can't do deferrals. So about the only thing you can do there is you can issue warrants, which I do. You can, if there are vendors of the town, not employees, but vendors, you could take the money out of their vendor pay. You can suspend local licenses and permits. You can hire an outside collection agency. I know large towns and cities do that. The fee for the company is paid by the delinquent, so you're not losing any money on it. You can transfer to titles in litigation if it's appropriate, and what that means is if they are in bankruptcy, you can put it in taxes and litigation, or you can actually take them to court. Now, usually that's done only if it's a good size bill, because there's court costs and everything else. And if all those don't work, you can always ask the Board of Assessors to write them off as uncollectible. Okay. And here's the next piece is the site, Chapter 60, Section 93, which gives you the law on how you can withhold payment of any monies due a person who owes taxes or other committed charges. And I would suggest that if you do that, you write them a letter to go with the check they receive, if they receive one, explaining what happened to the rest of their money. One of the best ways to get people to pay the bills, especially personal property and real estate, is to use Chapter 40, Section 57, suspending local licenses and permits. I urge you all to adopt this as a local option. It denies any application for or revoke or suspend any local license or permit, including renewals or transfers issued by the board or department for any person, business, or corporation who owes taxes. And it is no longer a 12-month window. When I worked in a town where there was a lot of building going on, a lot of subdivisions, the builders quickly discovered that in order to get their licenses and get the building permits, they first came into my office with their checks, paid me off, and then they were able to get their permits. It worked wonderfully because all it took was one or two of them to get told, no, I'm sorry, here's the amount you owe. You have to pay this before you receive your permits. It worked very well. You can also do it. You know that there are some institutions in your town that get licenses. It may be a bar. It may be a car dealership or a repair shop or a junk auto place. They get permits perhaps from the town. They owe you money. Let the town, whoever issues it in the town, know not to issue them their permit, or remind them every year to check with you before they issue the permits to make sure that they are paid current. It works very well. When we talk about taxes and litigation, we're talking about people who've gone into bankruptcy. And if they are in bankruptcy, then you should record a statement to continue the municipal lien with the Registry of Deeds. And this then would mean that your lien period is no longer the 3.5 years from the end of the calendar end of the fiscal year. It can go on forever. So if you've had somebody like some of the towns around here did, they had trains and tracks and all that kind of thing. And the train company, was in bankruptcy for like 20 years. And then when they finally came out of bankruptcy, then they were able to force payment. So it can take a long time for the bankruptcy, depending on the name of the kind of company, to get taken care of. When I was talking earlier, I mentioned that you should record everything in what is usually a spreadsheet. Well, here they call it a control book. It reflects every transaction from the initial point of entry to the final entry that reduces the balance to zero. And it's not every single one. It's, this week I had $1,500, so I post the $1,500. And you should you should maintain it. It is something the auditors will look for, and you should preferably check it periodically against your own balance. Print out your balances, find out what your balance is for this particular commitment or this particular year, and then look at the control sheet and see if it agrees. And if not, then you have to figure out why it doesn't agree. It's also a good idea to balance your accounts with your deputy collector, because sometimes you may have collected something and failed to tell him or her or it. So please be careful of that. Here are some other statutes that may be of interest. 40, section 22F allows municipalities to fix reasonable fees for services provided. Usually it applies to licenses and etc. But some communities use it to increase the municipal lien certificate fee greater than what's allowed by law. And the Department of Revenue interprets reasonable to be no more than the cost of providing the service. Chapter 60A, Section 1, which is a local acceptance, provides for the exemption of motor vehicle excise taxes for Massachusetts residents on active military duty outside the country for at least 180 continuous days of the excise calendar year. If accepted, all delinquent accounts incur an additional $3 fee when sent to warrant. Now we have a little quiz here. Let's take a minute and go through it. It's not hard. For example, who is required to prepare a commitment list and warrant for the collection of real estate and personal taxes? Well, earlier I said, who was it? It was the assessors. Early payments can be made with a special warrant from the assessors. That's true. Demands are always due in how many days? 14. The collector may include a stuffer with tax bills, even if it increases postage, as long as the department that requested the stuffer pays for the additional postage costs. That's false. In order to legally establish the date that a tax bill is first mailed, the collector must prepare an affidavit of first mailing. Eligible taxpayers may defer real estate and other assessments up to what % of the assessed value? 50. Okay, now we've got a mess because what happened was converting from PDF to Word created this mess here. What's considered to be the most effective remedy for enforcement of collection of taxes on real estate? The tax title taking. And liens expire how many years from the end of the fiscal year? What did we have here? That's the end of the fiscal year. Careful. That's not the end of the calendar year. So what is it? 3 years and 6 months. During the 14-day notice period where tax tithing partial payments can be accepted. No, they can't be. Just a little bit of basic stuff for you. Check my time and let's continue. Ooh, I'm running. Okay. Municipal lien certificates are something you have to be very, very careful about to make sure they're accurate. Most of us that are lucky enough to have computer programs have the computer program do it for us anyway. And therefore, at least you don't have to worry about missing some parts of it. If you're doing it manually, be very careful. Also be very careful because sometimes you have situations where you have other departments whose information you have to rely on. Such things as water, sewer, electric light, maybe even trash, anything that creates another liability and has to be paid. Now, the person's supposed to give you a written application. Usually get these from lawyers. And they ask for this for a municipal lien certificate. And these are for all payments on which a lien exists. Now, remember, the lien really exists as of January 1st of the year in which the fiscal year begins, although it doesn't perfect until you don't pay the bills. How many days does a collector have to furnish a municipal lien? That depends on the size of your town. If you're in a municipality of 5,000 people or more, you only have 10 days, excluding Saturday, Sunday, and holidays. If 5,000 people or less, you have 20 days. Once again, no weekends or holidays. And believe it or not, there is no penalty in the law if you don't do it on time. And there are two different sets of laws pertaining to what your fee could be. Most of us have adopted Chapter 60, Section 23, especially in small towns where you don't have a lot of you don't have 3-family houses, you don't have commercial, you don't have much industrial, you don't have any of that stuff. So that's a flat $25. If you adopt Section 23A, it depends on the kind of land or property you have, what the tax is. And you notice in 23A, some of them, it's much lower than the $25, which is kind of weird. And 23A had to be accepted prior to 1/1/88, so you can't adopt it now. Once again, you can also do the municipal lien through Chapter 40, Section 22F. And what I gave you on the next page is actually a classification, a law clarification by DOR on that issue, saying that, yes, you can use it to increase the fee above the $25 or the amounts in 23A. But once again, it cannot exceed the cost of preparing and providing the certificate, including indirect costs. Now, let's continue on with some other questions. And we're going to talk about what happens if you don't do it right, because that's very important. Can the collector keep the municipal lien fee if you're under property under in a town under 5,000 inhabitants? The answer is yes, if provided by bylaw. How many days does one have to file a municipal lien? It should be filed within 150 days of the issuance. And you will find that most lawyers file it immediately because they want that information on file in case you made a mistake. Now, the next question should say, what is the effect of an improperly filed municipal lien? Okay, let's say, for example, you fail to indicate that there is a water or a sewer outstanding bill, or even a real estate outstanding bill. What happens? It may discharge the parcel of real estate from that specific bill that wasn't listed. However, it does not affect the obligation of the owners at the time that such a lien becomes effective, and it may mean that you will have to take the owners to court to get the money. Once again, a lot of times this is being done because of a sale. Because of the sale, you're changing owners. And if you're changing owners, your lien has the time clock ticking. So be sure that you have everything you need on that. There are some things, however, that do not affect it if you miss it. For example, if it's already in tax title, it's been sold at a tax lien sale. It has had a statement of a statement to continue municipal liens recorded, once again, because of a bankruptcy. Anything where there's already something on file at the Registry of Deeds cannot be discharged by your failure to list them. In my case, we have this Title V situation that I mentioned earlier, where people have borrowed from the town through a state program to redo their septic systems. And that their document, their lien, is filed at the Registry of Deeds by the Board of Health. So that should I forget to put it on a tax title, it's not going to affect its validity. Another type of lien, if you have a demolition lien on a property, and it's once again filed at the Registry of Deeds, would be another thing that is not dischargeable. Street betterment or any kind of a betterment. Once again, it is filed at the Registry of Deeds, so it's not discharged. But in this particular example, an unpaid water charge would be discharged or could be discharged unless a certificate of acceptance at the registry has been filed. Okay. Municipal lien is properly recorded and the collector made the following errors. Incorrectly indicated that 2011 real estate taxes were paid. Then you got a problem, don't you? Because you may end up having to go into civil court to get the money because it has discharged any prospective lien, as well as with the water and sewer. Another question that may come up is about subdivisions. Can a definitive subdivision plan be recorded or registered without a municipal lien? The law says no, but the last sentence of the law, talk about a way out, says failure to comply with this section shall not affect validity of the subdivision plan, the recording of the plan, or any deed or any part or all of the land shown on the plan. there really isn't any penalty for not doing it. So we have the same problem that we have in other things. They don't tell us what's going to happen if it isn't done. Once again, very important. I urge you in your offices, even if it's being done on a computer, have somebody else check it over before you mail it out. Because otherwise you can get into a problem. I have certain comments that I actually put through my computer on my municipal lien. For example, because my property, some of our properties are in classification and have reduced rates, I always have a thing that says this property is in classification under Chapter 61. Please be advised that there may be rollback taxes due. This is more to the lawyers because a lot of lawyers have no clue. We have Community Preservation Act that's treated in my system as a betterment. So I tell them that the CPA is a betterment and it has to be paid with the tax bill, because it's amazing how many people try not to pay it because the lawyers don't understand it. Another one I have says this property has a personal property tax bill. Please arrange for payment, because they don't realize that second residences, which a lot of my people are living in or summering in, have a personal property tax bill. And if they sell the house, they have to handle that. And I don't want to be in a position of having to figure out who to send that bill to. So the lawyers then have to know that that's there. And lastly, of course, is the one, this property is in tax title. There's also a thing on the bottom of my municipal lien certificate that says, I know of no other liens outstanding. And if I do, if I know there's Title V, if I know there's tax title or something else, I'll actually cross that out in black marker. Granted, no lawyer has ever called me and asked about it, but still I get rid of it because I cannot legally say in all proper ethics that I don't know of any if I do know of some. Okay, let's take a look at the municipal lien certificate. Questions. How many business days? If you have a community of 5,000 or less, how long do you have to do it? Well, it is 20 days, which is basically 4 weeks. How many days? If it's more than that, well, then it's only 10. I assume the assumption is if you have 5,000 people or more, you probably have staff. I don't know what it is. What is the fee for a municipal lien certificate in Chapter 60, Section 23? That's $25. That's the flat fee. The other one, I've got to find my list here to be able to answer the other one. Just a second. What is the fee for a 1 acre building lot? It would have to be $10. Under what circumstances can an MLC preparation fee be less than the fee schedule indicated in the statute? And that was a comment made at the bottom here on page 11, where it talked about 1 acre building lot is it's a $50 fee, I'm sorry, for the 1 acre lot. However, in 23A and 23B, the fee may not exceed 0.5% of the assessed value. So that would be how it could be, where it'd be less than in the fee schedule. Are there any conditions under which a collector may keep the MLC fee? Yes, and that is if the town is under $5,000 and they've voted approval. Within how many days of issuance of an MLC must it be filed at the proper registry of deeds? That was 150 days. In the following example, which liens would be discharged from the subject parcel? A collector issues an MLC, which is timely recorded, with the following errors. I love this. This was obviously a bad day. Incorrectly indicates that the fiscal 2022 taxes were paid. Well, that is dischargeable, so that would be a yes. Fails to indicate that the parcel is in tax title. Well, tax title is already filed at the Registry of Deeds, or should be, so the answer would be no, it's not discharged. Fails to indicate that municipal water bill is past due. Once again, that is, yes, it can be discharged. Fails to indicate the water betterment assessed on the parcel. That's a betterment. Betterments are recorded at the Registry of Deeds, so the answer there is no. The first step the collector should take to collect any discharged lien is, well, normally it's to write a letter to the person and say, you owe this money. And then if worse comes to worse in the last one, what would they do next? It would probably be take it to court and you have a year. So that completes everything to do with municipal liens. Once again, please be very careful of that certificate because it's very, very important that it's done accurately and correctly, because it can really cost the town some money and can be very embarrassing for you. And with that, I am just about done and I'll turn it back over to Beth, I think, or whoever.
I just want to thank you for so much information. Great job. Are there any questions while we're still on? You can say it, write it in the chat, and then Ellen will answer.
I'll try. I know I gave you a lot of information, and it'd be so much easier when you have the thing in front of you to be able to read it.
But I just want to mention to everyone that it's on our website. I'm going to update the few little typos that we saw because of the conversion from PowerPoint to Word. But if you missed anything from the first couple things, everything will be recorded and has been recorded. And I really want to thank you all for doing this. Next week, we're going to be doing the advanced school. And then the week after is going to be on February 3rd. And that one is for introductory for treasuring. So there's a lot of information and we really thank all of you for staying with us all day. 85 of you on there. It's great.
This is amazing. I thank you all for being interested and concerned about your jobs. And we look forward to actually probably seeing many of you at school when we actually have school. And
there any other comments?
nobody?
Wow.
Wow. I'm shocked and amazed.
I'm stopping the recording.